to be respectful of everyone's time. It is 9 o'clock, and I am sure that everyone will be filtering in as we get started. I see Terry has joined us. Good morning, Terry. Thank you for joining us today and for giving us your time. This will be recorded, and so yes, you don't have to worry about that. I just started recording it. So once I receive the recording from Zoom, I'll make sure that everyone who participated today will have a copy of the recording. It will also be posted on our website. So good morning again. My name is Deborah Davis. I am the Regional Director of Minority Business Assistance Center, which is housed at the African American Chamber of Commerce in Cincinnati, Ohio. Joining us today is Joseph Reyes. He is a CPA and owner of Reyes Tax Planning. And so Mr. Reyes is going to take us through the 3 financial statements. And if we have enough time at the end, he will talk about business structures. So this is going to be an exciting day. It's going to be a lot of information. If you have questions, if you don't understand something, please ask your questions. This is what this webinar is for, is to teach you about the importance of the 3 financial statements: balance sheet, income statement, and cash flow statement. He's going to walk you through that. He's created a dummy company for you. So I think you're really going to get a lot out of this webinar. So please, in order for this to work, you must engage, you must ask questions. So thank you so much for everyone for joining. I see Connie, Karen, Mandy, and Camille have joined us today as well. And now I'm going to turn this over to Mr. Reyes, who is going to introduce himself, give you a little bit of his background, and then proceed with the webinar. So thank you again.
Thank you, Deborah. It's good to be with you. Thanks for inviting me to participate and to share the little knowledge that I have about this wonderful topic about projections and financial statements and things like that. As Deborah mentioned, first of all, good morning, everybody. My name is Joe Reyes. I am a CPA. I've had my own practice now for 10 years. Prior to that, I've worked in small companies. I've worked in very large companies. And the interesting thing is that what the topic we're going to be talking about today, guess which companies are doing the things that we're going to be talking about. I guarantee it's not going to be the unsuccessful companies. So, and usually the larger companies, the more successful ones, they take the trouble and the expense to do the exercise that we're going to be talking about here. But that requires a good amount of effort and stuff like that. So, I'm in the Philadelphia region. I'm also a consultant with the Widening University Small Business Development Center in Pennsylvania, where we help small business owners with free consulting on various topics that they need. I specialize in capital formation, getting loans and credit. I also offer advice on accounting and tax issues. I'm also a very big proponent of tax planning. So with that, we're just gonna, I guess, get started on the topic at hand, which is projections and financial statements. So there are 3 basic sets of financial statements. As Deborah said, is the balance sheet, the income statement, and the cash flow statement. When you are analyzing your business, and when anybody else, an investor, a banker, whoever, is going to analyze your business, they don't want to see just your profit and loss statement, the income statement. They need to see all 3, because the 3 together provide a 360-degree view of your business. So for instance, a balance sheet is a statement that shows how much you own, which are called assets, how much you owe, which are called liabilities, and the difference between the 2, which is the equity in the business. And if you think about your house, if you have a house, or most people know something about a house, you buy a house, that's your asset, and if you have a mortgage on it, that's the liability. Guess what the difference is? That's the equity. And we all know a lot of people like to refinance their homes and take money against the equity of the property. Same thing with a business. You have what you own, what you owe, and the difference between the 2. And so, you know, that balance sheet is like a life to date financial statement. It just accumulates over time. The difference between the balance sheet and the income statement is that the income statement just reports activities for just 1 year or one period of time. That could be monthly income statement, which we recommend that you take a look at. It could be a quarterly financial statements. If you watch the business news, the Fortune 500 companies, public companies, they're all big on reporting quarterly financial statements. And there's a whole lot of effort and expense and time that goes into producing those financial statements. And of course, those are done by professional accountants. Or you can do them semi-annually or annually. But once a period closes, let's say the annual of a year, January 1st to December 31st, once that year closes out, it resets. And then it's, 2022, you're going to start with zero income, zero expenses. So you see, you got a balance sheet that accumulates over years. So if you've been in business for 30 years, that balance sheet is just going to be a conglomeration of all the activities regarding what you own, assets, what you owe, liabilities, and the equity. And then the income statement is just resets. So you got the balance sheet, you have to state the income statement, and then there's something called the statement of cash flows. And that term speaks for itself, cash flows. And what that means is, where's the money coming from? And where's the money going? So that is a different animal than, let's say, the income statement. The income statement just shows, okay, I had sales and I had various types of expenses, and this is the net income, right? I am a small business owner. I've been working with small business owners for a long time. I've been in all kinds of companies. And guess which one of these three statements always gets the most attention, right? It's going to be the income statement. If you're listening to me, you're probably a small business owner, and that's probably your focus every year. How much money did I make? And how much do I have to pay the tax man? And how much do I get to keep? By and large, that's the mindset of the average small business owner. And I get it. We go into business so we can make money and live, right? I mean, that's the whole point. But if you want to grow a business, if you want to develop a long-term asset, which is what a business is, it's an asset, you have to pay attention to the balance sheet. And you have to pay attention to the statement of cash flows, because sooner or later, you're probably going to go to a banker, or somebody might see your business and like it and say, hey, I want to buy into that. Or you might want to put it up for sale or something like that. And everybody's going to be saying, okay, I need to look at your balance sheet, because your balance sheet is going to tell me a certain story. It's going to tell me, yes, what you owe, what you own, what you owe, and the difference between the two. But it's also, and we're going to see this in a few minutes, it's also going to tell us and tell everybody the strength of the balance sheet. That's a huge factor. When you go to a bank and you want to borrow money, they're going to take your balance sheet, they're going to run it through certain projections and financial ratios. And those ratios are going to tell a story. And that story is going to be, all right, yeah, you got accounts receivables, you got accounts payables, but which one is bigger in relation to the other? And what does that imply? So if you have accounts payables that are higher than what you have coming in, or owed accounts receivables, guess what? You owe more than you have due. You have a very weak financial ratio on your hands. And what that's going to do is going to tell an investor, a banker, whoever, there's a certain amount of risk here that they may not want to take, right? So that's really important. It's just not what you own, what you owe, and the difference between the two. It also says this company is strong or this company is weak, and that has implications, right? So you got your balance sheet, you got your income statement, and then statement of cash flows. When let's say a banker is going to look at your statement of cash flows, they're asking themselves, where's this person's money going? What is this business doing with its money, right? Because that also tells a story. So I say all that to lay the groundwork for these three financial statements tell a story. And as a business owner, you have to be concerned about all three. You cannot just be concerned about the income statement, because as important as it is, my recommendation is you want to build a business that's going to be strong and sound and that's growing and it's going to serve your purposes and is going to keep you out of trouble in the future if you keep it well analyzed and well maintained. And by well maintained, we're talking here about the topic at hand, projected financial statements. Now, I've been, as a CPA, I've had to go through 4 or 5 years of college. Then to become a CPA, I had to study a lot and take a very tough exam. And then I had to have a lot of experience. And the stuff that we're going to be talking about here is important. It's really complex stuff. But I think the way we have it structured here, SCORE gave us a spreadsheet and a tool that we're going to use, and we're going to show it to you. You're going to see that you don't need to be a professional accountant to understand what we're going to show you here. But you may need a professional accountant or a bookkeeper, somebody decent with numbers, to help you plug the numbers in. But by the time we're done here, I think you're going to see a tool, you're going to see analysis, you're going to see ideas that's going to hopefully help you understand what you're dealing with in your business and give you that macro view. So what I want to say to you is, it may be a little complex, what we're going to show you here. It's going to be a little bit in the weeds, not too much in the weeds, but quite a bit in the weeds. Don't focus on that. Don't let that scare you, because you could always hire somebody to plug data into a spreadsheet, right? If you're a business owner and you're really good at selling widgets, you've got no business doing bookkeeping. Hire somebody to do bookkeeping, right? Hire somebody to do the accounting. But when you get the final product and you have your financial ratios, as a business owner, that's what you want to do. You want to step back and take a look at the strengths and weaknesses of your business, and then address the weaknesses. What is wrong here, and what can we do to fix that, right? So that's where you get with an accountant or a financial analyst to discuss, okay, our accounts receivables are too low and our accounts payables are too high. Which is the problem, right? It could just be that the accounts receivable needs to be worked on. Maybe you're not billing well enough or high enough, because maybe the accounts payables are adequate for your business. And that's another thing. When you're looking at your business and your projections, you're not only looking at your business and your projections, but you have to take into consideration, what is your industry standard, right? So in a restaurant business, right, the food costs should be higher than, let's say, somebody who has a trucking business, right? It's obvious. So when you're comparing your business and financial ratios, and there are tools out there like Profit Sense is one that comes to mind. Love that product. You know, you plug this data in, your financial data in there, and out pops a whole bunch of ratios, and it's based on industry standards, right? So I would caution you, when you're looking at your ratios and your numbers, that you don't want to be comparing yourself to somebody outside of your industry. You should always be comparing yourself to other companies in your industry. And even then, you may not want to compare yourself to somebody who's in California when you are in Alabama or Philadelphia, right? So you start with comparing your company with your industry in your region, and then expand it out to see how does it look nationwide. And by doing those types of exercises, you as a business owner are now starting to think more analytically, and that analytic strength and characteristic will serve you very, very well in your business. So I highly recommend that. So with that, we start with a small business brief that SCORE put together about projected financial statements. So projected financial statements are a best estimate of a firm's future financial position. And to do projections, it gets tricky because there are assumptions. So you have to test your assumptions behind these financial statements, and that takes some thought. And I've worked in Fortune 500 companies, and when we've done budgeting and forecasting for the next year, you will be amazed at the level of subjectivity that goes into putting numbers together. And so it's not just a matter of using the tool, it also comes to critical thinking and understanding your business, understanding your industry. So we have a tool called the Excel 1200 XLS. We're going to show that to you in a minute. I'm going to walk you through that, and it's a spreadsheet tool in which we put all kinds of data like forecasted sales by product line, selling prices, direct labor, materials, gross profits, and I'll explain these terms to you if you're not familiar with them. There'll be monthly budgets for overhead, like selling and administrative expenses, salaries, operating expenses, things like that. So I'm not gonna read all this to you because I can just ad lib it, to be honest with you. I live it, right? So the income statement, like I said, it starts with recording your income and expenses. There are different types of expenses. We're going to get into that. So we're going to plug some data into a tool, and then we're going to see what the income statement looks like and projected income statement. We're going to use a 3-year projection cycle. You can use these tools to create a 5-year projection cycle. You can do it for 10 years. It's just a matter of tweaking the formulas in the spreadsheet. So once we place all the information to the income statement, whatever, and the balance sheet, we're going to wind up getting the cash flow statement, and it's all going to flow. And so what I want you to focus on, by the way, is
Joseph, it's Deborah.
Yes.
They're asking if you're going to share your the spreadsheet.
I am.
Okay.
Yes. Yeah. No. So by the way, so I'll share the screen right now?
Yes, you have access. You should be able to share it.
I'm going to share the screen. So, all right. So again, this is just, and I forgot this is the document that I'm reading off of a little bit. So, and then, so what I was saying is I want you to focus. Yes, you're going to see numbers, you're going to see formulas, you're going to see all that stuff. What I really want you to do is be thinking in terms of flow, right? Because we're gonna make some assumptions, we're gonna enter some data, and you're gonna start to see it go through this spreadsheet tool, and it's gonna end up in the final product of what the financial ratios look like. But I want you to be thinking more in terms of analytics. Don't get too hung up on, how do I enter that data? Where did that data come from? That's too much in the weeds for you as business owners, unless your business is accounting, or unless your business is financial analysis. You should focus on building your business by doing what you do best and managing the business and getting somebody to enter the data. But you should understand the mentality, the flow. And if we can accomplish that for you today and get you to understand that, I think we've got a big win, because then you're going to start looking at your business from a different perspective. And trust me, you will not regret it. It can be mentally exhausting maybe sometimes, or maybe you're so small a business that you may be saying to yourself, this is absolutely way too much energy and effort for such a small business. And I would say to you, probably, but you can take what you're going to see here and reduce it down to a very small level so that you can still put together not only your financials, but projected financials, so that you can look at where you're going to be in 12 months. And also, if you're starting a business, I don't know how you can start a business without doing this. If you start a business, you're looking to start a business without doing the exercise that we're talking about here, you're basically winging it. You're just thinking, I've got the cash, I'll just get started. I know the business, I know the industry, and I'll just get it going. That may be true, but you might be missing something. And that's why this exercise is so important. When you're doing the budgeting and forecasting, you might miss a piece, and that piece could be very, very important. So if you're forgetting one little piece of, let's say, materials, or purchasing a finished of an inventory item, and you overlook it or you miscalculate it, You don't know if every time you sell a cup of coffee, you might be making a penny, you might be losing a penny. You don't know. So it behooves you to go through this exercise, even if you're very small. And if you're going to start a business, this is very critical. Don't cut the cost and don't avoid the costs of doing this process. So you guys can see my screen all right? Deborah, the screen looks all right?
Yes, we see the brief. We don't see the spreadsheet that you've been
It's
talking
coming.
about.
It's coming. So, so we're going to be talking about unit sales and sales price forecasting, and then we'll get into the balance sheet. We talked about that, and then the cash flow statement. So, all right, so let's go. Let's get into the spreadsheet now. So here is the tool that we mentioned a few minutes ago. It's called the Excel 1200 tool. Now, SCORE has a multitude of free tools that you can access. And maybe, Deborah, you can talk about that a little bit, where they could find all the tools that they can possibly use for these types of exercises.
Yes, so SCORE, if you go to cincinnati-score.org, Google that, it'll bring you to the SCORE website. And on their website, they have webinars and workshops you can sign up, webinars for free. They have a library, a resource library that is packed with information on everything from what we're discussing today to how to price your product and your service, how to create a business plan. They use the business model Canvas business plan. They also have a very lengthy template, which is like 45 pages for business plan. They have information on marketing. They have information on sales, how to build your customer base, how to do your market research. So SCORE is an excellent resource for any business owner to take advantage of. So please Google Cincinnati SCORE or go to cincinnati-score.org, or you can also do SCORE.org, which is the national SCORE website, and you will see that there's tons of information there for you, as well as an opportunity to sign up for a mentor. You can, if you need a mentor for your business in any area whatsoever, they have hundreds of mentors that are available to assist you in starting a business and growing a business, and even in selling your business. So please check out SCORE's website. The resources are phenomenal.
Thank you, Deborah, for that. And thank you for mentioning selling the business, because what we're talking about here, when you're going to sell your business, you know, I have a client right now that's selling off a chunk of its business, and you know, the venture capitalists and the private equity investors, you know, this is all the stuff that they want to look at. They want to see projected financial statements, and they go down to micro numbers, and they go deep into the weeds, you know, because they want to know what the assumptions are. They want to know where the numbers come from. But if you're looking to sell your business, you want to get the maximum buck for your, you know, possible. Well, in order to do that, you want to have really tight projections, because that helps price and value the business. You know, so the stronger the business, the better the projections, the more money you get for it. And, you know, if you're a baby boomer like myself, you know, this business is an asset that you're hoping you could sell off and retire from. You know, so you definitely want to do that exercise. And so okay, so here we are with the Excel spreadsheet, and you see we've got multiple tabs at the very bottom, and we start with this introduction, and you'll see that, you know, it's a bunch of tabs at the bottom. A lot of these tabs, though, are going to be calculations. You see the gray ones, they're going to be calculations, and the yellows and the greens are going to be where we make entries. And once we make those entries, the calculations inside the Excel spreadsheet will kick out the final products, and then we're going to talk about that. And again, the analytics, the mentality, the flow. If you can master that in your head, you've got a big win. And then just hire somebody to maybe do the data entry and do the calculations. So what it is, I set up a dummy company called Space Exploration Materials, Inc. And I did that because Deborah and I were talking about the Jetsons and how today we're seeing the story of the Jetsons come true. And Elon Musk is taking us to Mars and beyond. So space exploration is a great industry that I think deserves attention. So we created Space Exploration Materials Inc. And then we entered data like projected sales by product or service lines. And we'll talk about that. So we've got monthly unit sales. We've got selling prices and variable costs. And I'll explain terminology to you as we move forward. Salaries and wages, owner's compensation, salaries for, executives. And then you have hourly employees, and that's where variable cost comes from. And then we're assuming that, this is a startup. So we are plugging in things like, the purchasing of fixed assets and how much money of funding the owners are putting into the business, and where they're getting money from, also sources of funding, loans and things like that, so that that's called capitalizing the business. And oh, by the way, if you don't have enough capital to start a business, I caution you to be very careful, because a lot of people ruin themselves by going into a very expensive endeavor, that they can't afford, and then they're shut down and they're out a huge amount of money. So properly financing and funding your business is absolutely key. And this process, this exercise will help you do that, because you will see it from a bird's eye view. Okay, gee, this is going to cost me X amount of dollars. Where am I going to get that kind of money from? And then you proceed from there, right? And then with cash receipts and disbursements. Then we have, once we're done, we're going to get an income statement, a balance sheet, cash flow statement, and then we're going to have something called a break-even analysis, which is a very interesting metric, because once you know what your break-even number is going to be for the year, and you know that you're going to hit break-even, let's say in May, then you get pretty excited, because you're thinking, okay, assuming there's no more pandemic surprises, hey, I might actually be in the profit from June to December, and hey, I can plan on that and and work accordingly. So there's that. So before we get started on the next tab, any questions so far about where we are? And Deborah, will somebody be reading the questions?
Yes, I will.
Okay, great. All right, so worksheet notes. We don't need to get into this. We're just going to get right into the projected sales, and then I'll explain from there. So what I've done is there are four. This tab has four products, four items that we're manufacturing. So we're assuming this is a manufacturing company, and I was thinking in terms of, we're manufacturing so that Elon Musk and his SpaceX company, or Amazon's Bezos, and Brandon, they're all purchasing huge materials for the space age. So we're manufacturing to sell to them, and that's a manufacturing process. This particular tab has space for 2 product lines. And then the next tab has space for another 2 product lines. And then, of course, if you want to build it out, you can build out for as many product lines as you want, but you'll get the idea. So here we are with this is the projected sales forecast. We want to know what a thing's going to look like based upon certain assumptions. So the assumptions that I'm making are, number one, that we are selling based on contracts. Obviously, if you're selling rocket boosters, parts, it's not the kind of thing that's on a store shelf in the supermarket, right? It's the kind of thing that's a special order. So usually that's going to be a contract. So if you have a great sales and marketing team, and you close some deals, you're going to have a contract. Once you have the contract, you can start deciding from there what your sales are going to be. So with that assumption, part A, rocket part A, I said it's going to be $5,000 a part, and that's, I try not to go too big. I try not to go too small. So the price, we figured, well, the price per unit of that is going to be $5,000. And these are numbers that I just picked out of the air, right? Because it's going to serve our purposes. And then I figured, well, maybe it costs $1,000 to manufacture that particular product. Well, what does that mean? So something called a variable cost per unit. So what that means is when you have a manufacturing facility or any business, and there's always something called a direct cost. Direct cost means what it costs to produce, manufacture, or deliver that product or service without taking into consideration other stuff like overhead, being rent, utilities, other things that maybe everybody in the building or the business, they're all sharing or producing that expense. But this variable cost per unit is a very focused cost. So you may have a product, you just envision a factory that has, all they do in that factory is produce rocket part A. And if they produce rocket part A, all the people in the line, the factory line, the assembly line, or whatever, they are considered a direct and variable cost. And what that means is that if you sell 2 units for $10,000, your variable cost is going to be $2,000, right? The more you sell, the variable cost is going to go up in proportion to the number of units made, not necessarily sold, but made. Hopefully they're all sold. So $5,000 for the selling price is what we estimate, $1,000 for the variable cost. So that means then I'm estimating that my gross margin per unit is $4,000. So it's a very simple concept. You've got your selling price minus what it costs. It's also called cost of goods sold in the inventory world, right? So I have a gross margin of $4,000. And you'll see to the right of that, the analysis is the sales price is 100%, and then the cost is 20%, which means that I have a gross margin of $4,000 or 80% of the sales price. It's called the gross margin. Now, there's a difference between the gross margin and the net margin. You got the gross profit margin. There's a gross margin also known as gross profit margin. And then there's the net profit margin. The net profit margin is, at the end of the day, all expenses in from every place imaginable. That's my net profit. That's what I'm going to take home. And then I'm going to pay taxes on that. So, but the gross margin is hugely important because it tells you right off the top whether or not this exercise of selling at $5,000 for something that costs $1,000 to make, is that product producing enough profit to feed and support the rest of the organization? Like, bookkeepers, janitorial work, rent, utilities, any number of expenses. That gross profit margin must be high enough to support the rest of the organization and the rest of the business activities, basically known as the support activities. If you mess this part up, every time you sell a unit, if you're losing money or not making enough money, you're looking at trouble, right? So this exercise that we're talking about here is going to help you see if all your assumptions are like tight or very reasonable, and you put the numbers together and you're coming in with a gross profit margin that maybe, is too low, then something's wrong and you have to address it before you sell another one or you manufacture another one, because every time you just keep going, you're losing money and it's just trouble, right? So, yes.
Hi, it's Deborah. I just want to, when you talk about assumptions are based on what the industry is doing. You're looking at the industry and then you're looking at your business and trying to make assumptions based on that data, right? It's not like you're just pulling numbers out of the air and say, I think it can be this. Your assumptions are based on the research
Right.
that you've done regarding your industry, correct?
Yeah, absolutely. Again, yeah. So for what I did here, of course, we just did whatever. But in the real world, you can't just pull numbers out of the air, and you can't be, you can't be optimistic. You can't be pessimistic. You have to be realistic. So it is based upon your industry. It is based upon research. It's a bit of a complex thing to do, but if it's a really small business that you're operating, it shouldn't be that difficult, right? So, but you're absolutely right. The assumptions are based upon, what, your industry, what's realistic, where you are, location, demographics, all that stuff has to come into play. And so a lot of thought has to go into coming up with the assumptions and then applying them in this type of a model. So the answer is absolutely. Did that answer the question?
Yes, it did. I just wanted to make sure that everybody understood when you were talking about assumptions, what that meant and what is required to go into developing those assumptions.
Right. And a great assumption is, right now, because of the pandemic, the cost of lumber has skyrocketed. So if you're producing a product that involves lumber, the assumption has to be, what is lumber costing nowadays, right? And you have to project out, and the major corporations are always projecting out big time, and then they start to buy futures and make investments in inventory in advance. But so you have to look at the industry, you have to look at the economic situation you're in. Is the economy turning downward, upward? Is there inflation? All that kind of stuff. The bigger you get, the more important it is. But the assumptions, it can be any number of things, and that goes into the calculation. So good question, good point. So we have a $5,000 sales price. We figured out, it costs us $1,000. We got $4,000 that supplies us with the cash or the profit to grow and to support the rest of the business. And then, so this is a projected financial statements webinar. And so what we want to do then is say, okay, based upon, what we have here, the next assumption is, how much growth do we think we can experience in the second and third years? And we're only doing 3-year projection, right? So how much growth can we see? I went aggressive with 10% and 25% because this industry is a high growth industry, and and money is pouring in, and things are accelerating at an incredible pace. But your industry may grow maybe at 1 or 2% per year. You have to understand that and plug that into the model. And so I just went with 10% for year 2. Notice there's no entry in year 1, because year 1 is the numbers that we have, that we just recorded of 5, 1, and 4. And then I said, 3-year growth might be another 25%. So with that, I started to build the basis for what my sales projection is going to look like. Because if I can start with where we are now and project out 10, 25%, we start to build out, into the future, what our sales numbers are going to look like based upon the assumptions that we currently have. Then you see overhead expense allocation. And what does that mean? So, like I said, you have your variable cost per unit, right? Variable costs are all the expenses incurred in directly producing that unit. But overhead, it could be your accounting, bookkeeping department, your legal department, any number of people who are not on the assembly line, shall we say, right? So rent, fixed expenses, any number of expenses that come in to play that are not directly involved in producing that unit. So I went with so let's say we come up with a very large, let's say it's $10 million, and we're going to get into that later, but let's say it's $10 million. And I figured, well, the amount of time and space that this particular product, Rocket Part A, takes, we think it basically eats up about 15% of overhead. So if you take everything else, selling and administrative expenses, insurance expenses, or whatever, there's a way that you can figure out this particular product, we can apply 15% of all those other costs to that product line. That's called cost accounting. It's a specialty, right? So but a lot of that is also assumption. Some of it's subjective, but should be mostly objective. So you figure out, okay, 15% for this particular product line of overhead. And that then becomes a part of the calculation of Rocket Part A. How much do we sell it for, or can sell it for, what it costs to make, and how much do we apply to overhead. And that gives us a little bit of, you see down this section down here, you see it gives us projected revenue for the year, variable costs for the year, gross margins, overhead expenses, and that's that 15% we just talked about. And voila, we're seeing that we'll probably make $3.5 million of profit on Rocket Part A in year one. And oh, by the way, we have a net profit margin of 58.61%. In the real world, that's ridiculous. Okay, in the real world, net profit margins typically will run maybe around somewhere between 2 to 15, 30%. Rarely do you see 58% unless it's some massively outrageously profitable product that's new or something like that. But it doesn't matter. The story remains the same. We have a little snapshot here of what we're going to look like in year one. And then below that, the software, the Excel spreadsheet has a formula that says in order to break even, we need about $1.6 million in sales, which means that based upon the pricing and all that good stuff, we need to sell 321 units for break even. And once we sell 321 units and we continue on with the projections, we're going to be in a profit mode. Does anybody have any questions about that little exercise? You're going to have an MBA in accounting soon after this minute.
Okay. Joseph, I do have a question. If you can, okay, so projected revenue is 6,000. Where did you get that 6,000?
So T14, hold on a second. I think we had like a few thousand units. Oops. So you see that 1,200 there?
Yes.
So that 1,200 is total units sold in year one at 5,000 units.
Okay.
So if we do 5,000 times 1,200, that's $6 million.
Okay.
And so this is year one.
Okay.
And then the same thing, you'll see the $1,000.
Okay.
1,200 units gives us the 1.2. So we enter this information, it starts to spread out, it does the calculation, and then it pops over here to give us the summary breakdown.
Okay. All right.
4.8 is just the math. And then the overhead expenses, and you'll see, if you're familiar with Excel, you'll see all these, the spreadsheet. I don't know if you can see it because I have this toolbar that I have to get rid of somehow, but.
Yeah, we see it. The formula?
Yeah, so you see the formula and,
Yes.
Just that can get confusing, but you get it. So that's where that comes from. And so just by doing that little exercise, you've basically achieved a lot, I think, because that tells you that you understand your business. You have a certain understanding of the moving parts here. Yes, there's a lot more to these numbers behind the scenes. In other words, how do we get to $1,000 per unit? What's inside of that? Well, that could be factory wages. That could be purchases of materials and raw materials and supplies to manufacture a whole bunch of, usually in what you see here, there's always going to be a schedule or some kind of report behind those numbers and assumptions that tells you where those numbers are coming from. So there should always be a trail for supporting these numbers. Like $5,000 per unit, that's might be easy enough as just going to a contract. Say, we have a contract. Elon Musk said, I'll buy it from you for $5,000, every unit, $5,000. Well, that's a given. But what happens when you have a business that is not so simple? What if you have a business that has, like a supermarket, a restaurant, lots of moving parts? How do you do this for every single product? Well, every industry has its own unique problems in coming up with selling prices. Sometimes it's not actual selling price of one unit. Maybe it's a daily sales price, because it's everything added together. It can still be done. It may not be picture perfect, but experienced people in these matters can get pretty close. And then you use industry standards.
Okay, Joseph, we have a question from Marianne. And she said the problem most people have, or business owners have, is how to market to really reach the sales. So basically how to market your business in order to reach the sales. She said that's one of the major problems that businesses have. But that's a marketing issue. That's understanding your customers' demographics, psychographics, and things of that nature in order to reach that customer. But I'll let you speak on that.
Yeah. So, but that, but that's actually a very good question, because if I want to reach 1,200 units in year one, well, how do I get to 1,200 units sold, right? It's one thing to have a contract because the prices could be fixed, but what if I'm just selling to the general public and I don't have a contract? Well, my sales forecast is not based upon a contract. It's based upon something else. It's got to be, so I got to figure out, how do I get there? So I can tell you this, if you take an economics class, one of the first things you learn, economics 101, supply and demand, right? That's number one. Number two is, I learned early on, the more you market, the more you spend on marketing, the more sales you're likely to experience, unless there's something else wrong. So I have a client right now that they've been in business for 2 years, and they have been pouring like hundreds of thousands of dollars into Facebook advertising. And it's a very curious thing. Every time they up the Facebook advertising, their sales go up a certain percentage. So that formula, there could be a correlation that can be figured out. So this exercise of doing projected financial statements can help you get to a marketing decision, right? You just have to understand the correlation factors. Like for every dollar I put into advertising, I should expect $1 of sales. Well, if I want to get to, $6 million in sales, well, then I can extrapolate and get to that marketing dollar amount, right? And every time these guys lower their Facebook advertising, their sales went down. So as you do some trial and error and you see what the market is doing for your industry, you can get to a place where you start to get a feel for what happens. But I can tell you this, if there's a demand for your product, the more you market it, the more you spend on marketing, the more sales market share you're going to get, right? That's just basic stipulation of economics and marketing. So you just have to figure out the correlation. But if you want to get to $6 million in revenue, and you determine that it's going to cost you like, $1 million in marketing costs, well, isn't that something you're going to want to know as you do your projection? And if you're a startup, isn't that something that you would want to know? So this exercise of projected financial statements helps you make those decisions. But then you got to talk to a marketing, like Deborah said. It's not an accountant is not going to help you with that. Now, they can only do the numbers, but you'll need to speak to a marketing expert or somebody that can help you, analyze that situation.
Yeah, and I just want to say this, it also speaks to whether or not you're solving a problem of your customer base. Are you just producing a product or service that you think people want, or are you actually solving a problem that they have and therefore they need your product or service in order to deal with the problem that they have? So that's the other aspect of that too. Let's see, Marianne, she says, This is so important, and some may have to change. Hold on, it just went away. Some may have to change the product if there is no demand. You have to realize you are not reaching your projections. Okay. So
Yeah,
that was
good
just a
point. I
statement
mean,
that you made.
there's a guy, I'm in near Philly, Lansdale, Pennsylvania. I drive by this storefront all the time. You know what they do? They do typewriter repairs. Who uses typewriters? I think maybe people in the spy industry who don't want to see their their document traced, but nobody uses typewriters anymore. So my guess is that this guy's not growing. He's probably going to be out of business. So, and if you watch, I mean, one of my favorite shows was Shark Tank, right? You learn everything you see on Shark Tank, it nails it. You know, there's got to be you got to be solving a problem, or you got to be filling a demand, or you got to create a demand. And
Right.
you know, before the iPhones ever came along, there was no demand for iPhones. So Steve Jobs and Apple, they created the demand for iPhones, but other than that, you know, you got to solve some problem and bring value to people and businesses and solve problems like you said, Deborah.
So Karen has a long question. How is this projection applied when you don't have a specific product and are a distributor or broad scope of products in an industry like medical, and you have no idea which product will be procured, especially when you have no term contract yet of a specific product? How do you research the industry or customer that is unpredictable with procurement?
So that's another great question. And it's a great question simply because it was asked in the context of what we're doing here, right? So if you're not doing this, you're probably not asking the question, and you're probably not able to put down numbers that are going to start making sense. And that is the kind of question that you have to seek the answers for in your industry and your specialty or whatever, because I obviously don't know, but that's the kind of stuff you got to be thinking about to get to the assumptions that you need to start projecting out and figuring out, am I on the right track here? Because if you can't answer those questions, I would recommend not spending your life savings on starting a business that's not gonna, because it's just a guess, right? So what this process does is it helps you develop concrete thinking, realistic expectations, and figuring it out. Like, okay, I have no way of knowing. How do I do this? And then you start on the path to finding those answers to the question. And you know, every industry is different, every product is different, but if you don't have a product, then obviously you're not going to get started. But if you're buying product from a distributor, right? Well, you got to figure out, well, where are the distributors? Who are they? How long have they been in business? Are they successful? Can I rely upon them in my area? Who's doing this in my area? You know, who's the competition? What market share do they have? So that's like almost an MBA in business that you have to develop to get there. But you use somebody who knows, use informed professionals to start developing the answers to those questions before you go spend your hard-earned money and life savings on an endeavor that you don't know the answers to. Right. I don't know if that helps with you, the answer to your question.
I think, yeah, it's a very broad question, but I think you're right that it goes back to research and understanding your industry and what the trends are in those industries, whether you're a distributor or you're not. But like with the Minority Business Assistance Center, we have access to IBIS World. IBIS World is a research company that collects research from every industry that you can imagine, and they break down, the growth in that industry, who the competitors are in that industry, and that is available to all of our clients, number one. Also, the library, Cincinnati Public Library, has a very extensive business department, and they have a gentleman there, I can't remember his name off the top of my head, but I've gone down there and he's worked with me. He works with business owners and helping them conduct research. They have several software systems at the Cincinnati Public Library that you don't have to pay for, that you can access on your own. And again, Joseph is correct. seek out experts within that particular industry. Use their knowledge base to help you figure out what your assumptions should be and how you can gather the numbers that you need in order to create your projections and figure out how many units you should sell. So, and then again, that goes back to SCORE. They have mentors that have experience in various industries you can use, that you can tap into. So there are organizations with people that have expertise in these particular fields. You don't need to know everything. You just need to know where to go to get the information you need to develop your plan of action to move forward. So having said that, I'm going to, we have another question. I'm going to toss it back to you so we can continue, because I want to make sure we get through all the statements.
Yeah, no rush. We got plenty of time.
Okay, so Karen, where's Karen's? Oh, Karen says, there was another question. Oh, Karen says, my government customers so far are never consistent with products. They ask me to source or supply. I sell medical products. Okay. Well,
so it's hard to forecast. You're just, you're just supplying the demand as the demand occurs.
But isn't that a way to, if you track that historical data, that variable data that changes every month or every quarter, then based on that, you should be able to come up with an assumption. Well, it's just sort of like the stock market. It goes up, it goes down, it goes up, it goes down. But if you look at it from a historical perspective, you can see that there is a trend there. So you should be able to, if you're able to track this data from your government customers, you should be able to see what the trends are within that, whether it's seasonal, maybe the demand goes up for one season, goes down during another season, or maybe it's quarterly, or maybe something's going on in the industry that may impact the needs of your government customers. So you've got to be aware of what's going on in the news that may impact your government customers, and you've got to start tracking that information. That's the only way that you're going to know how to price your products or your service that you provide.
Yeah, and so good points, because I think about the food industry. You go to the supermarket, right? I mean, nowhere else can you go, well, maybe clothes, but some of these retail industries, right? How do they know? How do they know what to buy, when to buy, how to price it? Because it's all based upon the finicky favorites and trends of human nature. So, they try to forecast it and meet the demand as they come along. So if for instance your demand cycle is volatile, well, then you had better make sure that your fixed costs are not so high that they cannot destroy your business. Because if you wind up with, like, for instance, rent, if you have a very high rent and all of a sudden your demand for the product falls, and now you're not making enough to cover rent, you've got a problem. And that's part of the break-even analysis. And I got to say, it makes me real happy to hear that these types of questions, because it means that we're thinking like CEOs. This is CEO thoughts, right? And if you're a small business, a sole proprietor, or you're a large company, you're a CEO, you have to be thinking along these lines. And you see these very successful CEOs out there. What do you think they're thinking? They're thinking these thoughts. And then they delegate, and then they go out and make sure people, have experts that they can rely upon, and do the trend analysis and look into the future. And it's it's a big deal, right? I mean, there are companies out there that all they do is forecast trends out 5, 10, 15, 20 years, right? And then they come back to their employers or their clients and say, this is where we see things going. And then, a good CEO, right, is going to start looking at that and planning around it and trying to get ahead of the game. It's a game, right? But a lot of energy goes into that. So, but we're thinking like CEOs when we get to that point. Any other questions?
No more questions. Thank you.
You're welcome. Good questions. So here we are. Like I said, Rocket Part A, you know, we know, now we know we have a projection out, and then the 10% is going to show up on, you see down at the bottom here, we enter the projected sales, and then we salaries and wages. These numbers are going to start showing up when we get to the income statement. You'll see in a few. And so now a manager or an executive of this business is going to look at this stuff, and they're going to ask themselves, does this meet the goals that this company has? Is this acceptable to us? Is this number, or these number of units, what's it going to take to make 321 units? How much effort does that fall into line with the corporate goal? Because you got to have somebody at the top saying, these are the goals, and then the people underneath execute the strategy, and they have to ask themselves, is this going to meet the goals that we set for ourselves? And if this analysis shows us that, yeah, 58.61% to the bottom line, if I'm the CEO of the company and I see that, and I see another division that maybe is doing 10% to the bottom line, I might be having to make decisions about that, won't I? Maybe I got to dump the 10% and pour more resources into this one and expand that out. So that's part of the net result of doing this process. So then we move on to Rocket Part B, and it's more of the same. I just pulled numbers out of my head, and I said, all right, the next one is $6,000. Part B is $6,000 per unit. Variable cost is $1,200. These numbers have nothing to do with Rocket Part A, although they could, right? But in my mind, I'm like, okay, I just have 4 separate manufacturing runs, if you will. And again, I kept it the same, like growth for year 2 is 10%, year 3 is 25%. I kept that consistent with the first part because I figured, well, if we're selling parts to, SpaceX, and it's for a particular rocket program, if Part A goes up by 10%, then Part B should go up by 10% too. But that's just an assumption, right? And so with that, and then I figured out overhead allocation, this one takes a little bit more doing. It eats up more utilities, it eats up more other stuff. So I just said overhead allocation of 30%. And with that, I came up with projected revenue of 7.2 million, variable cost 1.4, gross margin 5.7, overhead expenses of 2.5, and net profit of $3.2 million. So I figured this particular product is giving us a 44% net profit percentage. However, like I said a few seconds ago, if I see one product delivering less profit margin than the other product, well, maybe I can't get rid of Part B. Maybe I have to sell all these parts. So there's nothing I could do about the 44%. I can't put more money into Part A and not manufacture Part B, because maybe the rocket can't take off without Part B, right? So we have to eat it the way it is. So with that, I'm going to look at it as a cost accountant, and I was a certified management accountant years ago, and I was well trained in cost accounting. And I can tell you, we look at these numbers, and then we start to think to ourselves, well, what can we do about these numbers? Maybe the variable cost per unit is too high. Maybe we could bring it down. Maybe we can fire, don't shoot me for this, but maybe we can fire some workers and put in some machines and robotics. And guess who does that, right? All the major manufacturers do that now. And when we do that, maybe my cost per unit can go down. But what does it cost to buy it? And and then you do the analysis to figure out, well, it's a big investment up front, but in the long term, that variable cost per unit can come down, and maybe that 44% now can start to go up a little bit. And we start making decisions and keeping up with the trends and technology or whatever it is. So just this little exercise by itself can give an executive, a business owner, food for thought. And it's the kind of stuff that you're sleeping, 2 o'clock in the morning, up pops an idea, and you just solve the problem, right? Because you've done this exercise, your numbers. And if you watch Shark Tank, what did they say, right? you better know your numbers. So, and then here we got a break even of 3.2 and 535 units. So, and then we go into the next tab, and then we have more parts. So part C, part D, more of the same, right? I just made assumptions or whatever, and I have a net profit of this product of 22%, and then part D, net profit of 63%. So it's kind of all over the place because each part has different requirements. You don't know. It's not always going to be standard, but I kept the 2-year growth at 10% and the 3-year growth at 25%. I tinkered with the overhead expense allocation just off the top of my head, but again, that should always be based on some kind of reality. And cost accountants, that's their job. That's the stuff that they're supposed to do. And so with all that said, we've basically entered the data just for the product. Again, services are different. You just got to go through it. In my industry, I'm a CPA. I have a staff of like 6 people. Guess what my number one cost is? It's salaries and wages. It's brains, the software is secondary. So my biggest cost is employees. So then I just got to figure out where can I get the best employees for the least cost and work from there, and then do trial and error. So then the next tab, speaking of wages, is we want to figure out what is the salaries and wages for space exploration materials based on certain assumptions and realities, right? And the reason we're talking about salaries and wages is because now you got sales, that's income. We nailed that. Now we got to start thinking about, okay, what are my expenses, right? Salaries and wages are usually very high numbers for companies, that have employees, obviously. So we made the assumption here. You'll see assumptions are that I have as a number of people are concerned, I put down 2 people. 2 ladies decided to start this business. So they're 2 owners. What are they going to earn for running the business as CEO and vice president or whatever, right? So we want to make it. I made an assumption. Well, CEO, many CEOs make $480,000, $500,000 a year, and okay, $40,000 a month, right? That translates into $480,000. Now, mind you, I came down to this 40,000 because I have plugged in some other numbers, higher numbers. And when I got to break-even analysis, I got to net profit percentage, all that stuff, the numbers were not looking good. I'm like, okay. And if I'm running this business, I'm thinking to myself, the numbers are not looking good. Something has to give. And that's part of the process of the projected financial statements. You enter your data as best you know how, and there's some things that maybe are subjective. Some things are hardcore. There's nothing you can do about it. You got to have all that data in here. And then you step back and you take a look at your projection and say, well, this is a waste of time. We're never going to make money. We're going to be bankrupt in no time. Or we change things. Well, the owner's compensation, I had it much higher. I brought it down to 40,000. Usually, if you're the owner of a business, usually you're the one who gets paid last, right? So, but if it's an ongoing enterprise, you start to take a salary, you can start projecting it out. But if the salary you're taking out is sucking up the profits of the business, then you got to start taking less salary. You got to do something else, right? And so most business owners I know, they understand I'm the last one in line to get paid, and that's okay for startups and all that stuff. But after a while, you got to be making money off the business, or you should be doing something else. And that's what this helps you do, because if what you're looking at here doesn't make sense for putting money in your pocket, guess what? Go do something else, because your cost of capital, your opportunity cost is too high. And opportunity cost is, what am I giving up by doing this? So if I'm only making $480,000 a year doing this, but I could be making $1 million doing something else, I'm losing $520,000 a year. So by doing this process, you're starting to think, okay, what's going on here? What should I be changing? Maybe I need to not do this. So in any case, I made the assumption of 40,000, 2 owners. So, and then salaries, I figured, well, 5 people making $40,000 a month for 480,000. So you can see the numbers. And then I estimated full-time employees. Now wages is one thing, salary is another, right? Salary is a fixed amount that you get paid. Usually it's like office workers and executives and stuff like that. But then you've got wages, which are more like the people who actually do, the work to produce and stuff like that. They get paid by the hour, let's say, right? So I put down 20 employees. It's a space technology company. It's going to have, it needs a lot of manpower. And I figured, well, 20 full-time employees, 40 hours a week, I estimated $30 an hour, the work that they're doing. So it's just assumption. And then part-time employees, I figured I just cut it in half, 10 employees at $20 an hour, 20 hours a week at $15 an hour, right? And then I didn't put anything for independent contractors, but, a lot of companies need independent contractors. If you need that number, you dump it in, but you do that exercise, and then you come up with a monthly year one total wages. And that's not so hard to come by, because once you know what you need to do, you can figure out what's it going to take to get it done. And it's very easy to come up with wage numbers and salary numbers, because that's out in the market. It's easily calculated. And then it's $197,000 a month. I know my salary costs are going to be $2.4 million, right? And then employees, cost not just money, they cost you in expenses. You got Social Security, employer taxes, right? You got all kinds of stuff. You got pension plans maybe, or 401k contributions that come out of the company's pocket. And so I made assumptions. Now these assumptions here were built in because these are based on current tax law. But employee pension plans, that you could do 5%, you could do 4%, you could do 8%. It depends on the structure that you want to build out, the benefits you want to give out. So a lot of these costs or percentages are pretty easy to figure out. Once you figure out how many people you need, you just multiply the percentages and you come up with what we see as being total salaries and related expenses. So when somebody says, oh, I make $100,000 a year, you know what the employer is saying? Yeah, but you're costing me $120,000 a year, because my overhead, my other expenses for having you could easily be 20%, right? So that's why a lot of employers today are giving people wage notices and benefits notices to say, yeah, here's your salary, here's the benefits we gave you, this is your total value, which is interesting to know, right? So then you have it's just a calculation now that comes out to 2.9 for year one. And then we go to the next tab and we do the same exercise. And I went with certain assumptions that we went to up to 25 employees. We kept the two owners the same, the salaries, the executives, we kept them the same, but I said, okay, we're gonna hire more people, full-time, part-time, whatever, and same number of hours, but I calculated the hourly rate to be 10% more, and did the same for the part-times. So just so that you can see how it works out. More the same. So now we got to $3.9 million for salaries and wages in year number 2. Again, we're doing a 3-year projection. Then I did it again for year number 3, and I just increased. I kept the owners the same, salaries. I said we're going to hire a couple more people. Did the numbers, and this, by the way, this is what corporate America does every single year when they do their budgets and projections. Okay, and if you stop to think about what you just saw, this is not, no pun intended, this is not rocket science, right? This is something that a relatively decent accountant is going to be able to crunch numbers for you and get the data and plop it in. All you got to do as a CEO, all you got to do is just be thinking about, well, if we grow this number by this percent, how many more people do we need? I do that all the time in my business, and that's what most business owners do. They figure out when they're going to max out, what do we have to do to now hire, and you just project it out. This is a lot easier than maybe figuring out projected sales, because that's an unknown, whereas this can be an unknown variable. And then we move on to the next tab, And this is where it gets really, really interesting, because now if we're a startup, for instance, what's it take to start up? Well, that's messy at best, right? So in this type of industry, I thought to myself, well, it's going to be very heavily requiring machinery and equipment. It's going to require probably a building to buy or rent or anything like that. And so we start to figure out, what do I need? And then we start to figure out where you see operating capital, what expenses are we going to have to meet just to get off the ground, right? So you could see that by doing these projected financial statements in this process, you start to put on paper the realities of what you're looking to do. And hopefully by doing this, you may not get everything. You may make mistakes. We all make mistakes. But if you can capture all the major pieces for your plan, for your business, for your endeavor, when all is said and done and you start to look at the final numbers, and we're going to get there soon, you can sit back and say, pillow talk with your mate, like, maybe we shouldn't do this, or like, yeah, let's do this, better than like, I don't know, let's just do it and see what happens. Not a good business strategy. Okay. So for startups, right, in this endeavor, I figure, well, we probably need to buy $500,000 plot of land, and which does not get depreciated, by the way. So depreciation, by the way, you see I have a building that I bought for, or I built for $1 million. Either way, we've got a building for $1 million. Well, tax law and accounting law basically says, well, you can't just write off the $1 million just like that. Sometimes you can, but let's just say you can't. You have to take $1 million and write it off over 39 years. That's called depreciation. And all that means is you're taking the $1 million, and every year you're going to take 39, you're going to divide 1 million by 39 years. Whatever that number comes out to, you're going to take that number and you're going to put it on your financial statements, on the income statement, as an expense, and it's called depreciation. Now, depreciation is also called a non-cash expense. And why is it called a non-cash expense? Well, that's because you expended the cash when you first bought the property. But after 5 years, you're not spending $10,000 on depreciation. You've already spent about the $1 million. You're just taking a piece of it and allocating it over the years. It's almost like when if you have a mortgage, right, and you have a monthly payment, the monthly principal is X amount of dollars and the interest piece is X amount of dollars. They're never the same. And over the years, that $1 million, the original mortgage principal, you're eating away at it little by little. So it's kind of the same concept. You can't just write off $1 million building just like that, unless tax law allows it. And this is actually a good time to interject something about taxes, right? I want you to keep in mind that what we're doing here are financial statements, has nothing to do with paying the tax man, right? This is just financial statement stuff, internal stuff. And if you're going to produce and you're going to publish the financials, that's fine also. What you report on a tax return is subject to current tax law. And so when Trump, he passed a tax law in 2018, 1118, and then Biden is set to set up a new tax law, new tax act. That's going to change things, right? It always changes. So whatever the tax law is, that's what gets reported on your tax return. But what shows up on your tax return is not necessarily what shows up on your financial statements. They're two different animals. And yes, one feeds the other, but there's sometimes like meals and entertainment. You can have all the meals you want, but you can't write it off in your tax return. You can only take half. So there's always a tax to book difference is what it's called. So you should always keep that in mind. When we're doing this exercise, we'll deal with the tax impact later, but just keep in mind, we're talking about projected financial statements, which is not the tax return. So they're not, they're not necessarily the same thing. 39 years for buildings, for instance, well, that's been, commercial property, business property, every one of those, like every one of these buckets, $1 million, $250,000, $1 million equipment, whatever. Each one of these has a generally accepted depreciation standard. So a commercial property can be depreciated over 39 years, but equipment, you might be able to depreciate that over 4 years. And so, and that, and there are different ways of depreciating things. So an accountant should be able to help you figure out what is the depreciation standard for these particular buckets, and then how it gets on the tax return. It could be an entirely other matter. Maybe it's not even depreciated. Maybe you could write it all off right off the top. And there, you need to understand how that works.
Joseph,
Yeah. Yes.
Terry has a question and Camille has a request. So I will do the question first. Let's see. Terry's question is, how did the numbers in column E, number 37 to 44, get populated? That's the first question. The second part of the question is, will we be changing percents ever in this section / column?
I'm sorry, repeat that second part.
Will we be changing percents in this section or column?
Which column? In the column?
Column E, number 37 through 44.
Well,
she wants to know
yeah,
how that
so-
got populated and will the percents ever change in that section?
Well, they can change, but these are calculations. If you see the formula, it's an if formula, right? So if we got G37 divided by G45, right? So G37, that's 100,000 divided by G45, total sources of funding, right? So if this number changes, this number is going to change because maybe one of these numbers changed. But the formula remains the same because this line here, this 100,000 is a percentage of this number here. And if this is going to change, it's going to be because these numbers changed. So we're not going to change any formulas, but some things is just, like these numbers here, you don't change them. You don't change anything. You change the totals because maybe outside investors, you see where we see $5 million. I put down, all right, we need to source money for this endeavor. I figured out we need to get outside investment of $5 million. Well, we can make that 4. So we can make that 4 million, and it changes the percentages. Does that answer the second point?
Terry,
What
does
was
that
the
answer
first-
your question? I'm sorry, Joseph, what did you say?
Oh, okay. The first question was, where did these numbers come from?
Yeah, how did the numbers in column E, 37 to 44, get populated?
Right. So so like this one here, 0.91. So if let's say you see, I try to delete it. I can't because it's a built-in formula. But let's unprotect this sheet. I'm going to unprotect this sheet because it has protections in it. So this 0.91, right? Let's say I do plus 100, because this is just basic math, to be honest, divided by 11 million, it should be 0.91, see? So you see this formula up here says G37 divided by G45, But the previous formula was another Excel formula. If G37 equals 0, then 0. Otherwise, G37 divided by G45, which is what I just did, except I didn't do the if formula, right? So that's just 37 to 44. It's just a formula to figure out what this line is as a percentage of this. And the same thing with each and all these lines here are going to be based upon this line divided by million, 11 million, this 5 by 11, 500,000 divided by 11. So these are just basic mathematical formulas. We don't need to touch that.
Okay, Joseph, the participants are in need of a 5-minute break. I think their brain is exploding. So we're going to take 5 minutes. Everybody can run and do what they need to do real quick, and then we'll get right back into it.
Good.
Okay? All right. Thank you.
Sure.
Okay, welcome back, everyone. So let's continue where we left off. Joseph, I'm going to toss it over to you and proceed.
Okay, thank you. So you said that people's heads are exploding. So Deborah can tell you that when I was talking to her about all this, I'm like, this is like super, like really complicated stuff. But just go back to what I said earlier in this session. We just want you to understand flows and thoughts. Don't focus too much on the weeds, right? Don't look too much to the details, because we're just showing you, ideas that are going to be cemented when we get to the end. And then that's going to be more thought focused and a little easier on the brain. All this stuff here that, all these entry points, frankly, you don't do yourself. So you hire somebody to do them. But every business owner knows that they're going to have costs when they start a business or they're running a business, right? So if you simplify it, yeah, I'm going to have sales, I'm going to have expenses, right? The thought process should be at the macro level, the 30,000-foot view. The thought should just be, I'm going to have income, I'm going to have expenses, and I got to know how they relate to each other and what the impact is if I do A and not B, or I improve this or change this, that kind of a thing, right? This kind of stuff, no CEO does this stuff. They have accountants, they hire somebody to do it. If you have a small shop, you're just starting a business, you could do it yourself on a sheet of paper. You can say, okay, I found a property, I got to pay $5,000 a month rent, right? I know that I need a cook. I know that I need to buy this refrigerator, right? So even at the lowest level, you're still going to do this exercise, right? And it's doable. But even a simple thing like putting on a sheet of paper just before you start a restaurant, okay, what are the pieces? Well, you got to know the business, right? You can't go into a business that you don't know. So if you're going into the restaurant business, there's certain things you know. You need a location, you need rent, you need a cook, you need dishwashers, you need plates, refrigerator, stoves, all that you need. And if you just put all that on a sheet of paper and then you extrapolate just what you know, again, for a whole year, you'll know that, oh, geez, I never thought of that. This isn't $5,000 a month. This is $60,000 a year. This isn't $1,000 a month. This is $12,000 a year. So by the time the year ends, okay, my costs alone are going to be $300,000, right? Well, that's a whole lot better than just doing it and just waiting to see what happens, because, oh, I found a great location, I have a great product, it's going to make a bunch of money. Well, that kind of thinking will bankrupt somebody, because you may be making a lot of money on the top side, but the bottom side is there's an expense item that's going to be a killer, and you didn't calculate that into your numbers, so that because you didn't do some kind of even a small projection, you wind up with a major surprise. So a simple thing, and I just doing that will help you, will speak volumes and help you tremendously. So don't let this fry your brain too much. Let the accountants get their brains fried. But if you're a business person, over time, you should be thinking like a business person. You should be developing the skill sets for that. So instead of you doing the bookkeeping, hire somebody to do the bookkeeping, and you go take a class on being an entrepreneur. You go learn something. I'm amazed. In about an hour at 2:00 today, I'm going to be part of a group where a bunch of business owners are going to be learning about bookkeeping. And I'm like, what's a business owner doing? Why is a business owner doing bookkeeping? A business owner should be figuring out how to sell their product, how to manufacture their product better, how to beat the competition, right? That kind of stuff. So, so don't waste your time on stuff you shouldn't be doing. Build your business, but you need data. That's what a CEO does. They get the data and they make decisions, right? And that's why they make such big bucks, because one decision can make a company billions of dollars in profit, and shareholders will reward that thinking. So, all right. So the startup funds, again, this is just basic stuff like, okay, startup. What do I need to start up? We came up with these, these items. We figured out we need X amount of dollars. And once we figure out how much we need, the next logical, oh, by the way, there's more, you've got these other expenses. So operating capital is different than assets, right? Because fixed assets. So, you know, you buy a piece of land, that land, well, you only buy it once, right? Until you're ready to buy another one years later. But operating capital is your day-to-day expenses to operate. That's what operating capital is. And so when you're starting a new business, there's always initial startup stuff. What do I need? So what this tab does, startup funds, is identifies all the pieces that we need. And then we figure out, I say, well, we're going to need $4.8 million working capital cash just to have in the bank. But these are the things that I got to buy and I got to spend just to get started up. And I figured, well, all right, we need $11 million to just set up. That's what startup is, right? Just to set up. So, so that $11 million comes down to here. And what we've done is we've identified, how do I identify, how do I get to this? Where do I find $11 million? Is really the question. And that's what this exercise is about. And I just figured, well, the owners are going to put in 100,000. They're going to find investors, put in $5 million. They're going to go to the bank, borrow 5 million, you know, mortgage, 500,000, credit card debt, 100,000, vehicle loans, you know, 200,000, because up here we have, I allocated 250,000 for vehicles and other bank debt. So I just figured, well, to identify how much I need to get started, $11 million, whatever the pieces are. This is, so how do I find $11 million? And these are the pieces that we identify as where you go to get the $11 million. And then as to the previous question, well, this 0.91% is just, this is 100,000 is just a piece of that 11. So this is kind of analytical. It just helps you identify, you know, where the money's coming from in percentages. That's all it is. Any questions about that? Okay, then the next thing is, so we've got projected sales. We figure out what we're going to sell, how much we're going to bring in. We then figured out, okay, what are my salary costs going to be? And that's, you know, for day-to-day stuff, whatever. And then the required startup costs. Now we get to fixed operating costs. Remember what I said earlier about making sure that your fixed expenses are not so high so that if there's a downturn in your sales, you're out of business, because that's where a lot of people get into trouble. You hear about companies all the time that because there's a downturn in sales, they are bleeding cash. And some things are fixed, like rent or mortgage payments, you know. So what do? They lay off people. They start to get rid of people that are not so fixed. And that's why you see a lot of times there's layoffs whenever there's a downturn in sales, because you can't get rid of a building unless you're going out of business. You just don't get rid of a building, right? You don't get rid of your cars. You only do things, you know, only when absolutely necessary. The easy thing to get rid of is people, because you can lay them off and you can hire them, right? So, so fixed costs are a very important thing. And so you see one of the fixed costs that we have here is advertising. Well, if we want $6 million in sales per year on one product, maybe we need to spend $50,000 a month in advertising. And so all these expenses are just your regular run-of-the-mill expenses of running a business. And then we have notes here about what's inside of all these, but we don't need to get there because hopefully you understand whatever the expenses are, you got to list them between what is a fixed cost that no matter what happens, rent, I got to pay the rent, that doesn't go up and down, and what is not a fixed cost. So this tab basically just gives us, we identify what all our fixed costs are, and then we go from there to the next tab, and that's cash receipts and disbursements. And this is just a metric to show us, based upon industry averages. And that's what I did. I just came up with numbers, but 60%. So if I send a bill to somebody, what is the likelihood that I'm going to get that money in between 0 to 30 days? You know, you just go off of industry averages, or you go off your experience and your collection policies. So, you know, with that, I'm like, okay, cash, I'm expecting 100% of cash for invoices outstanding to come in within 60 days, within 0 to 60 days. And then over 60 days, 10% of my clients are going to pay really late, you know, and this is not as hard as you may think to calculate out. An experienced accountant can figure that out pretty quickly based upon experience and industry standards. So this tab, just we can see from here, okay, you know, I get an idea of how much I'm gonna, you know, what my percentages are coming in. And these are accounts payables. So accounts receivable is what is I'm going to receive. Accounts payable is what I got to pay to my vendors and suppliers. And, you know, how am I going to pay? What is my payment policy going to be? Do I pay, you know, within 30 days? Sorry about the train. I'm next to a train station. Do I pay within 31 to 60 days? It's all based upon industry standards. And then we've got a line of, line of credit assumption. We figured, well, let's see if we have $1 million from the bank that we can just have in the bank as we need it. A line of credit is basically, it's just there. They give you $1 million line of credit. If you're short of cash, you need 200,000, go to the line, borrow 200,000. A client pays the bill. You can put that, and you can put that 200,000 back in. So that line of credit goes up and down, up and down. I highly recommend every business owner have a line of credit, because you don't know when things are going to turn down, right? We're still in pandemic mode, and now there's an Indian variant of the virus, and for all we know, we may get another lockdown. Lockdowns are still occurring around the world. Guess what? If sales are not coming in because you're locked down again, a line of credit can save you. It can be a temporary inflow of cash. So you want to have a line of credit if you can get it, negotiate, or just go, you know, whatever the interest rate is, et cetera. Assumptions of 2.1% for income tax and amortization of startup expenses, 5 years. I'm not going to explain that to you, but this is all standard accounting terminology. But this data flows into the cash flow statements and these other statements. So those are all the inputs that we're concerned about for this exercise today. And now we get into what I was referring to earlier. Now the spreadsheet is going to do the calculations and it's going to feed us data. And as CEOs, that's what we want. We want data coming back to us so that we can start to understand and think, right? Leave the calculations to the underlings. You're the owner, the CEO, you want to think, right? So now your accountant comes to you and says, well, based upon all the assumptions that you made and all the decisions that we made and best guesses that we had, we came up with a projected income statement. And I hope you guys can see that. I don't know if I can make that a little bigger for y'all. I think I can. So based upon that, remember we said we figured out what our sales were going to be for Rocket Part A, Part B, Part C, and Part D. I forgot to name that Part C, Part D. But, so you can see, and now based upon everything that we entered in that first tab, we came up with a number for the first year of an income statement of $29,400,000 for sales. So as the CEO or the owner, that's what you want to know. Oh, okay. Gee, we're going to see about $29 million in sales. That's a good start. Hopefully that's profitable, but that's good to know. And then, you know, based upon the data we put in, we see, oh,
we're going to see $2.545 million a month in the first year. And this is for fixed contracts. Again, like we said earlier, if you don't know what the mix is, it's maybe not easy to calculate what each product in the supermarket or in your restaurant is going to bring in. But if you can come up with average day sales, you can still come up with a number that gives you something to chew on versus not knowing or trying to guess and have nothing to base that guess upon, right? So it's really critically important that you use this type of tool and give it to somebody to populate for you, to give you data, or do it on a sheet of paper if it's a very simple process for a very simple business. And so this is just what we entered: variable costs, Rocket Part A, B, C, D. And we see that we're expecting fixed variable costs, direct costs of 6.8 million, and our profit margin is 22,560,000. And that profit margin is what cash that we need to pay for all the other expenses that we have to cover for the month, for the year, whatever. So now, because we did all that work up front, we have an income statement for the first year. And these are all the pieces that we saw on the other tabs. Excuse me.
Joshua,
Then,
not Josh, Joseph, calling you
Yeah.
Joshua. Joseph, there is a question from Camille. She wanted to know, is the salary line on 34 correct for 5 employees? The salary line for 34 says 40,000.
Right. Excuse me. So if we go back to salaries for the first year, because this is year one's financial statement, income statement we're looking at, we go to salaries, and there's the salary line. So 40,000 per month. And that, by the way, what you saw in the income statement, it's accurate for what I entered. I mean, it's just a calculation. It's not like reality, but so you'll see the owner's compensation. Remember, we had 480 for both of them. So does that help?
Yeah, I think she may have thought it was for the year versus for the month.
Well, that's for 5 employees, so
Right.
For 480,000, and salaries are usually like executives, which are higher paid, and maybe salaried workers, which are higher paid. So it's just made up stuff, I have nothing to base it on other than I was just trying to show you how this template works. But what you're seeing here are formulas based upon the previous tabs where we entered the data. It could be high, it could be low, So now we get an income statement, and for the first year, which is great, my net income for the year, based upon everything that we know and calculated out, we're looking at $13 million for the first year. Well, if I'm a business owner and I know that I do this my first year, I'm going to pocket $14 million or $13 million. And if there's 2 of us, we're each going to pocket $6.5 million. That's interesting information for me, isn't it? Now, if that number was $1 million, I project out I'm going to make $1 million. Well, gee, I got to work, 52 weeks a year, 40 to 80 hours a week because you're the owners and you work more than anybody else probably. And I'm going to make half of $1 million. I'm going to make $500,000, but I've got this degree, these credentials, I got all this stuff, and I can make $1 million a year myself doing something else. That's something you might want to know, right? Before you make a decision to go forward. So this template gives us the first year, exact same template for the second year, $14 million, and the exact same template the third year, $19 million. So we went from 13 to 14 to 19, based upon the assumptions and data that we input. So that gives us a projection. So if you run these numbers and you figure out, well, we want to borrow money. Well, bankers are going to want to know, well, what do you project this business is going to do? And if you give them realistic numbers and this is what comes out, I'm pretty sure the bank's going to give you the money. If it's $1 million, after all is said and done, the complexity of the business, the effort involved, the risks that you're taking, they may say that's not enough money. All you need is one thing to go wrong and you're in the red and we won't get paid. And so they go to the underwriting departments, and we're going to talk about that in a few. Underwriting department is going to say the risk is high, the risk is low. If the risk is high, probably not going to give you the loan. If the risk is low, probably give you the money if there's going to be a return on the money. So that is fed to you from the template, and this is really good information for you as a CEO of your business. This is really good information for you to have to help you plan. And if you don't plan, you might wind up with some nasty surprises. Then it also gives you the balance sheet, and the balance sheet, all that data that we entered way back when is going to feed into this balance sheet. And if I'm a banker, you give me this balance sheet, I'm going to say, okay, by the end of year one, you're going to have $20 million in the bank. Sure, I'll lend you money. How much would you want? You probably don't need the money, right? Because you got 20 million in the bank. But bankers and investors love to give money to anybody who's willing to borrow and pay a good interest rate on it, because that's how they make their money. So if I'm the owner of this business and I go to the bank and say, I want to borrow, $30 million, I'm probably going to say yes. I'm like, you got a strong balance sheet. You got a lot of cash. Your AR is not too high. Your inventory, all these assets that you own, are pretty decent. And, you have a bunch of property that you own, pretty decent. You got $27 million in assets. And this is what you own, right? Remember I said that earlier in the balance sheet. Balance sheet shows what you own. And then it also shows what you owe, which are liabilities and payables. So if we have assets of 27 million, but we only owe $8 or $9 million, that's a very healthy balance sheet. And so that means that you're not going to have much of a problem borrowing money or getting investors. You're going to start to attract attention. First of all, you're making money. Second of all, the business is profitable and strong. And third of all, capital is always looking to go someplace to work. And if a banker can make their capital, their banking money work in your business, they're going to be very willing to send their capital to you so that you can make it work and they can get a profit called interest, right? So, and then, so you got $27 million in assets. You got $9 million that you owe to others. That means that your equity in the business is $18 million, very healthy balance sheet. And that's the equity. Like, remember I said earlier, you buy a house, that's the asset, the mortgage is what you owe, the difference is the equity. Same principle here. The assets is what you own, the liabilities are what you owe, the mortgage, and the difference is your equity. You can take that equity, you can take it out of the business, put it in your pocket, you can leave it in the business for future growth, you can make decisions, and then you can start understanding what you want to do, not want to do. You got data, and as CEO of your business, you need data to make decisions with. You should want to see your income statement and balance sheet regularly. You don't need to crunch the numbers like all that other stuff that I showed you. That's for the underlings and the bookkeepers and the accountants to do. Your job is to look at the income statement, look at the balance sheet, and make decisions. So that's the balance sheet for year one. Here's a balance sheet for year two, based upon everything that we entered. Again, very healthy balance sheet, $41 million in assets. the business is killing it with cash. Now it's like they got $35 million projected in the bank at the end of year 2. Well, guess what business owners are going to do when they have that much cash? They're going to say, what can we invest it in? We can't leave it sitting around doing nothing. Do we invest it in Bitcoin? Do we invest it in the CD, stock market, or do we buy another plant and double our capacity to now go from 35 to 70? Because capitalists, that's how they work, right? Entrepreneurs, that's how they work. They want to, if they want to grow, they have a goal. They want to get as rich as they possibly can. They're going to put that money to work somewhere else. You have data that you can start making decisions about. And then again, with the 3rd year, because again, we're doing a 3-year projection. And if you wanted to do more, you just got to tinker with the formulas on the spreadsheet or whatever it is you pick up and the score tools that Deborah was mentioning earlier. So and by the way, you see where it says statement balances? That just means that total assets equals liabilities plus owner's equity. So this section here, all these pieces here have to equal all these pieces here. That's all that means. It's an accounting concept. You don't care if it doesn't balance. You just go to your accountant and say, this doesn't make sense. Why? Well, make it balance and then fire them and get another accountant who can make a balance sheet balance. So now you have that 3-year balance sheet. And now we get into the cash flow statement. This cash flow statement is the least popular financial statement. Honestly, as a business owner, you're probably not going to care about this except to give it to the auditors at the end of the year if they come, paying you a visit, or if you have investors. Outsiders are going to want to know this. If you're a sophisticated business owner with, financial training or accounting training, you would probably look at this because it would make sense to you. My advice to you is make sure this gets done and then don't worry about it. You focus on the balance sheet, you focus on the income statement, you make those two as strong as possible. The cash flow statement will take care of itself. If you have a good accountant or a good controller or CPA, they're going to focus on this. And if they see a problem, they're going to come and bring it to your attention. You're probably not going to want to.
But Joseph, if you don't have that and you have to rely, what will this tell you? If you have to look at this cash flow statement because maybe you can't afford an accountant right now.
Okay.
How would you interpret this cash flow statement?
Okay. So let me unprotect it and I'll be happy to answer that. So I just want to get rid of the So again, it's just, if you think about the words cash flow, in other words, when the money came into our business, where did it go? How did we use it? Where did the cash flow to, and where did the cash flow from, right? So if you remember early on, a while ago now, I had said, we expect to, get $4.8 million in cash to start up the company. So, January 1st year, and we were just getting started, we figured $4.8 million. Then, before the month was out, when the month was out, we had $1.47 million in income from sales. So we go way back to the beginning. Here. We should see, we should see 1.47 million. Where is it? It's in here somewhere. 2.4. So it comes from the income statement somewhere. Give me a second. So the
So it's the income, year one, income statement year one. So that's, oh, so it's two different. Because you know what, because we had sales and then we determined you want to get your heads blown. Okay, you're gonna get your head blown. You have your sales from month one, $1.2 million, let's say. Remember, we said accounts receivables, we have made some assumptions that not all that it takes 0 to 30 days to get 60% of the sale paid in cash into your pocket. So although we sold X amount of dollars, doesn't mean we collected X amount of dollars. We maybe collected that the next month. So that formula that you're looking at the cash flow statement is simply looking at how much we sold and then what the percentages are that we're going to collect in cash over a period of 30, 60, more than 60 days. And so that's how you get to that number. So the simple answer is this 1.47 is how much we collected, because there's the formula, cash receipts and disbursements tab, along with the income statement that was sold. So it's a formula, and it's not going to jump out at you unless you actually want to test the formula, but it works. So the answer is we have $4.8 million. We started with cash that we invested or we got from investors, and income cash came in at 1.47. So those are cash inflows. You see that? So basically the simple answer is you take your beginning cash, add cash that came in from sales, subtract cash that went out, cash outflows. Well, that's the big one, because the cash inflows is simple. It's your net income. It's your cash that came in. But how did we use the money? Well, we used the money by investing. Maybe we bought more fixed assets throughout the year, so there would be a line in here somewhere if we did that. Maybe we bought more inventory or have more inventory on the books. Variable costs as an expense, so that's where the money went. Direct labor costs, that's where the money went. Fixed business expenses, that's where the money went. Now this is cash. This is not depreciation. Loan payments, and this is what the bankers are going to look at. They're going to say, all right, where did the money go? Because if they're going to lend you money, they want to know that you can service the debt. They want to know that you can make the interest payments and the principal payments. So this cash flow statement highlights where the money's going, and it breaks it out by different categories. There are basically 3 categories for a cash flow statement. There's an investing activity, and fixed assets and stuff like that is investing. If you think about it, this is the one statement that trips up a lot of accountants in college. When we say investing, the first thing that probably came into your mind was, oh, TD Ameritrade, Schwab, investing the money to make money. No, investing means buying more assets to invest in the company, to crank up more profits, to crank up more business. So that's where investing activities come from. It doesn't mean what you think investing means. It means investing in infrastructure in the business. Operating is simple. Operating means, day-to-day expenses. So that's where the money went for that. And then financing activities, that's where financing means money, borrowed money, investor capital. Where's the money coming from? And paying off interest and stuff like that. So this is servicing the debt. And if you have dividends like stockholders, you pay dividends, so that's all that means. So this tells you a banker is going to say, okay, you got investing, operating, and financing activities, add them up together. These are your cash outflows. And then the net is the inflow minus the outflow. It's very logical, right? So if you pull back and just look at the big picture, you got money coming in, money going out. The difference is net. If your positive cash flow status is strong, that's telling, right? That tells you something. It tells an investor, a banker, something. It means that we're making good money, number one, but we're spending it well too. We are meeting all our debt obligations. We are investing it into, building the business bigger, so that's what this tells you. And then the last one is the operating balance. That's a formula. So that's like, I think it's this guy here, beginning balance plus the cash flow, let's say, of that gets you your ending balance.
So Joseph, what is
Yes.
the difference between because this looks like the indirect. This looks like, is this the direct approach to cash flow versus the indirect?
Oh, who's asking that question? Because that's an accountant's question.
I'm asking the question, Deborah.
I should have been warned about you. I think I forget which one it is. To be honest, this is the traditional. I forget the difference between the direct and indirect. That's intermediate accounting that I took in the 80s. But this starts with.
So the indirect, I'm asking this because I took a financial accounting class.
You're
years
thinking
ago.
of starting with net income.
Right, and then depreciation comes out of it.
Right, so you're thinking of, yeah, so I forget which one it is, there's two methods of doing cash flow statements, for the small business owner.
So do you recommend this way? Because I think this is the direct way versus the indirect, because I think what I remember is the indirect way has the income from sales, but it also includes depreciation. You've got to take out the depreciation first.
Right, so one starts with net income, and if you start with net income built into that net income number, you're breaking up. I'm sorry. If you start with the net income number, guess what's built into net income? Depreciation, which is a non-cash. Remember earlier I said if you buy a building for $1 million and you depreciate it over 39 years, well, that depreciation piece is built into your net income number. Deborah, I think you okay?
Yeah, we lost you. I think we're back now.
Oh, you lost me. Oh, okay.
Yeah, you froze and then I couldn't hear you.
Oh, okay. So depreciation, if you have net income, traditional net income, depreciation is going to be part of that. But depreciation is not a factor in cash flow statements.
Okay.
So you got to back out. You got to add the depreciation back to the net income number.
Right.
All you want is true cash flows. Right?
So technically you can do it this way then. This way makes more sense to me. So this way is an option for business owners to utilize versus the other way.
Yeah, so in the world of accounting, there's something called generally accepted accounting principles.
Right.
And there's two ways of accounting for your numbers, by the way, for your books. For most small business owners, you operate on a cash basis, right? Which means that you actually recognize income when you receive the cash, and you actually recognize an expense when you pay it, and that's how it gets onto your books. Mm-hmm. And your net profit is cash in, cash out. That's a simple small business, generally accepted accounting principle.
Okay.
There's something else called accrual accounting.
Mm-hmm.
Accrual accounting is actually the stuff that we're taught in school. Mm-hmm. Cash accounting is not, no corporation does that, right? No major corporation does that. Accrual accounting is simply, I'm going to recognize the income when I make the sale, even though I didn't get the cash. I'm going to recognize the income when I make the sale. Even if I get the income, the cash a year later, I'm recognizing the income now. And my expenses, if I incur an expense, I'm going to recognize it now, even though I may pay it a year later.
So you have to match the expense to the revenue.
And so the advantage to that is that if you use accrual accounting, what you're basically doing is you're matching your expenses to your income, to your activities. Okay. You don't care when the cash comes in, because if we assume that the cash is going to come in later, by matching income and expenses together in a particular period, that gives you even a better idea of how your business is doing. But the government the industry, everybody recognizes that accrual accounting is advanced stuff. Small business owners are not equipped to do this on a regular basis. Now you need an accountant who's well-versed and well-trained in generally accepted accounting principles. Sometimes you need a staff of accountants. So small businesses are just not going to do that. So it's become accepted that small business will just record income when the money comes in and will record expenses when the money goes out. When I started my company, I didn't do what other accountants do. Other accountants, they do that cash basis. I wanted to do mine with accrual basis. And because I want to see what my income is or my expenses, regardless of when I get paid or when I pay stuff out, because that tells me, it gives me a better idea how I'm really doing. Now, one of the talking points, one of the criticisms of accrual accounting is, well, if you are recognizing income when you sold something and you don't get the cash until months later, well, when you do your tax return, you're going to pay taxes on the income that you didn't receive.
Right.
And I counted that with, well, if you don't receive the cash by the time tax time comes, you got a problem. So you probably will have the cash in your hand by the time April, May, whatever, if you're an extension, by the time that money comes in. So it's not true that you're not going to pay, that you're going to pay taxes on money you didn't receive. The fact is, you probably did receive the money by the time tax time came. But depending on what you're doing, like if you're a big company, accrual accounting, very relevant, you want to do it. You're a small company, just cash coming in, cash going out, very accepted, you're fine. In the long run, it kind of evens itself out. So the way you do your cash flow statement, if you just do it based on cash flows, like what we see here, money came in, cash, and where the money went. This tells you, or it tells somebody who's looking at your business, it tells them what you're doing with the money. Because like I said earlier, you got the balance sheet, the income statement, and the cash flow statement. The three together tell a story. Each tells a piece of the story. But it's very relevant for somebody on the outside looking in, wanting to know, oh, what are you doing with the money? You know, so are you taking it out? Are you reinvesting it? If all you're doing is taking the money out, right, and put it in your pocket and you're not investing, well, that does tell somebody something. It tells somebody that, well, these guys are not really, or these ladies are not really looking to build a business. They're not looking.
It's a job.
They're letting things deteriorate instead of making capital improvements. So all kinds of thoughts and analytics enter into the fray. So that's why the cash flow statement is important. The average small business owner, I've been doing this for 10 years now on my own practice. I don't know any small business owner that even bothers with the cash flow statement. And in corporate America, the only people who care were the executives about the cash flow statement. The accounting departments, all we cared about was the balance sheet and the income statement.
Okay.
But the auditors are going to look at the cash flow statement. The bankers will look at it. And if you look at the Fortune 500 companies, all public companies, they must provide these three financial statements. It's generally accepted accounting principles standards. You can't not do it. So with that, so we have a cash flow statement for 3 years, etc. And so we move on. And then we get into, remember what I said earlier? We want to get to a place where we could think. You don't want to get into the weeds, but hopefully through this webinar, you're just getting a sense that there's a lot of details that have to be captured and that you need to get somebody to help you and capture that. But what you want to get on your desk as the CEO, and I want you guys thinking of yourselves as CEOs, what you want to know is the analytics, the data points are in year one, we sold.
Joseph, can you make that larger, please? Can you, make, because right now we see you and the spreadsheet, but we can't really see the spreadsheet.
Okay. How's that, better?
It's a little better. It's not as large as it was before. I don't know if I'm not sure how we had it before. Okay, that's good.
Sure.
Mhm.
One more for good luck. Okay.
Okay.
So, so we see here that this tab, all it's doing is pulling in from the other tabs and just giving you in a snapshot the overview of what's going on. And so we have part A, $6 million, part B, 7, 9, whatever. Year one, we had total sales of 29 million. Well, that's the starting point. So total sales over total sales is 100%. It's just a formula. But variable costs, you see 6.8. So variable cost is 6.8%, 6.8 million. So that's 23% of the 100% of the sales, right? So now you, as a CEO, you're gonna look at that and you're gonna say, okay, well, all right, we got 23% not bad in variable costs. My gross margin is 76%. Now, if you know your business, if you know your industry, and if your industry is saying, if the average person, the average business in your industry is doing a 50% gross margin and you're doing a 76% gross margin, as a CEO, you put on your thinking cap and you got to ask yourself, why? And that's what all good CEOs and business owners ask is why? Why is that number the way it is? You want to know why. And so you go back to your employees or your accountants or whatever, say, why is that? And you look for the answer. The answer may come back with, well, you have that secret sauce. You're just very good at what you do, and you figured out how to be very efficient, and you're killing it. Or they can come back and say, your prices are just more high than everybody else's, so you're killing it that way. Or there may be an error in your numbers, because if everybody else, you always got to remember, you may be smart, but there are a million other people smarter than you out there, and if they're all doing the same thing and you're coming in at way higher, I think a little bit of reluctance to accept things as they are is in order. But that's data. That's data you're getting to think. And that's what this is all about, right? Not to just do the numbers, but to understand them and to understand your business. And you can do this for a micro business. You can do this for a large business. So again, you have year one, year two, year three, blah, blah, blah. Gross margin, 76%. Then you have your wages and all that stuff. And you can see that your gross profits are 72, 70, 71. I mean, this is stuff that you start asking questions. If we're doing 72% and I'm only making 480,000 in owner compensation, maybe we should double that. Maybe we're not getting paid enough. Maybe our employees are not getting paid enough. Maybe we should give out bonuses. Maybe, we should plan on that. So you start to make decisions. And so that is the takeaway from this income ratio. It's all a matter of, as a percentage of sales, what is each line item doing? Does anybody have any questions about that?
Let me check.
I know this is very technical stuff, but we knew that coming in, right?
Right. I don't see any questions. So basically you're looking at this point, you start looking not just at the numbers, but at the ratios and comparing that to your industry and seeing what's, like you said, what's going on in the industry, what are the trends, and then making decisions based on the ratios and where you fit within the industry that your business is in.
And there are products out there. Now the last couple of tabs here have that information that you just said, but there are softwares out there that go even further. They give you a lot more detail about industry ratios, and by region and all that, and by size. You can break it down to smaller levels so that you can maybe you don't want to compare yourself. Like my accounting firm, I'm a small accounting firm, right? There's 7 of us. I'm not going to compare myself to Deloitte & Touche, which is a international CPA firm, right? Maybe I can't compare with them. My numbers, my percentages are not relevant, right? Maybe as a percentage, I'm more profitable because I have less overhead, right? So there are softwares out there that help you enter this data in, and I'll crank out data based upon, if you want,
by your region, by your size, etc. Now, if I'm comparing myself to my other small CPA firms in the area, and we're coming in at, at 40%, and they're coming in at 30, that just means I'm either, I'm a better, I have a better business than they do, or there's a mistake, but it gives you something to chew on, I'm gonna try and make this easier for everybody to see in a second. No, I'll get rid of this. Never mind. So year 1, year 2, year 3, blah, 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 so everything that we've been talking about now just condenses into here in a summary format, and out comes the bottom line. This is an income statement, so the bottom line is very relevant. And so the income is coming in at 45%, 45.6% of sales. This is 44.9% of sales, and 48. So, and in this ratio, we start with 100%, which is the sales number. That's always the way it's done. Okay.
And when, Joseph, when they say the gross profit margin ratio, what does that mean?
So that's this number here. So there are two margins to look at. Gross margin is what you see here, sales minus variable cost.
Okay.
Or sales minus cost of goods sold. This is a very common term, cost of goods sold, right? So the gross margin is basically that, is the direct cost of making a product or delivering a service, and does not include all the support and indirect costs and other costs. So gross margin is just that number. And then the net profit margin is all in, all other expenses added together, subtract that from the gross margin and from the sales number, and you wind up with net profit. So this 13.9 is going to be gross margin, gross profit of, oh, my bad. So there's the variable cost. This is the gross profit here. This is variable cost, but I forgot to include the full-time employees involved in that. So you got this, it's the same thing, gross profit margin. So you're gonna focus on gross profit margin. That's most of it. See these employee costs? A lot of times they get added up into this number up here. So it depends on how you design the financial statements. So at the end of the day, you just want gross profit margin. And it's the same thing. So gross profit margin is all the costs involved in putting the product together, minus from deduct that from sales.
So like on, I'm sorry, go ahead.
Go ahead, no, go ahead.
So like on Shark Tank, when they're always talking about Cuban and everybody's up there talking about, well, what's your gross, margin, and, how do you get your margins down? Is that's the variable cost? That's the cost that you have to pay to produce your product or your service?
Yeah, that's the highlighted line. That's direct costs, and direct cost is parts purchase, goods purchase, wages paid. Let's say it's a factory, that would be the factory worker on the assembly line. They're directly involved in putting together the product, right? So that's the margin. So that is what they mean by that.
Okay.
Because that's a key number. Because if your gross profit, everybody, sophisticated business owners understand, and financial people understand that if your gross margin is too low, everything, you're getting blown out of the water, because all these other costs are going to start eating away at it, like rent, utilities, payroll taxes, advertising, bank fees, whatever. So this is a huge indicator, gross profit, of how much it costs us to make or sell this product before anything else even happens, like salaries for executives. They're not included in that number. They would be included in that number as overhead, right? But that's later.
Okay. All right.
So you got to know your gross margin. Gross margin, gross profit margin basically means the same thing. The way this template is built out, they separated it out, but at the end of the day, they mean the same thing. Gross margin is your gross profit margin. It's an industry standard. That I would have put maybe did it differently, but it's your preference. Listen, if it's your business, guess what? They're your financial statements. You got to understand your own financial statements, right? What good is it to you if you have a set of financial statements that you don't understand? You can't get it, right? Maybe you think differently than other people, or maybe you like to see your financial statements in a different format because you're more creative, and you can absorb the information differently by having it designed differently. That's fine. You just have to know that there are two types of financial statements. One set of financials for you to make your decisions and for you to understand your business however best you can. And then there's a standard financial statement that the world and the industry and the market is accustomed to. What you're seeing here is a standard financial statement. Most people, most business owners just say, just go with what the standard is because it's too much trouble to maybe build things out differently. But you have all kinds, in corporate America, we were always doing all kinds of reports and Excel spreadsheets to look at something, to analyze it differently and look at it from different points of view. That's just considered a different type of financial statement. But my recommendation to you is you either understand the standard financial statement and what everything means, or you design it in such a way that makes it easier for you to understand because you absorb things differently. I'm the kind of guy who understands that, not everybody sees everything the same way. So we may see the same data and be thinking totally different things. Maybe you can get to the same place, another avenue, by having a more creative financial statement, whatever. But you'll find that most people use the standard financial statement model. But gross profit margin generally means the same thing. You can break it up, but don't let that bother you. It's just how it's designed, but the data will pay the same thing.
Terry has a question. She says, and I think you've answered this a couple times, but her question is there a percent that is a good standard or industry standard?
Well, see that's the word standard, right? So I know in the accounting industry that I'm in my size business, whatever, right? We know that net profit should be somewhere around 25 to 35% of sales. So if I bring in $1 million, I should expect to make $250,000 to $350,000. However, you could be an engineer and your industry standard may be 10 to 15%. You need to know your industry standard. And then that's what you apply to what your numbers are. You can't compare yourself to another industry at all. So, and then you have to ask yourself, is it worth my while, to make this net profit? That's why these analytics are so important, because they help you start making decisions. And I've had to tell many people, listen, you should shut down your business and go do something else, because you can make more money at McDonald's. Why are you doing this for year in and year out, losing money in the hopes you're going to make money? So far, you're never going to get your money. You're so way behind. You'll be ahead just by getting a job at McDonald's. So these analytics start to help you understand, what you're doing and what you should be doing or should not be doing. But every industry is different. Some industries do 1 to 2% of sales as their net profit. Some industries will do 50%. I have a management consultant that I'm working with, and she told me that I should be making 45%. I'm like, how could that be? The industry standard is 25 to 35, but she has her reasons for it. And I don't know if I agree with it, but I would love to make 45% on my sales. But different than a lawyer, different than, a bookkeeping firm, let's say. So you have to do the research to find out industry standards. That's key. I hope that answered the question. Was there a follow-up to that?
She said she just Googled it and the answer they gave was 23 to 25%.
Nice. That's a nice profit percentage right there. A lot of businesses don't do more than 10 or 15%. A lot of businesses, I think the restaurant or the food business or the supermarket business, they do 1, 2%.
And Camille wants to know, how do you do the research? I think I put some links in there. You can go to Profit Sense. They have a SageWorks report that gives you the industry standards and the ratios for your industry. There's also IBIS World. IBIS World, like I said, the MBAC program has IBIS World. You can also go to your local library. They have software there that you can utilize, and they also have people that work in the business department in the library that can assist you with your research to come up with what the industry standard is for your business. But the software that I just mentioned, especially IBIS World, it can be relatively expensive. So you really want to work with an organization that has that. Also, SBDCs have IBIS World, I believe ECDI. A lot of economic development organizations have these type of softwares that you can access. So that would be the best place. And then you can always Google and get information from that. But when you Google and you get different research companies, they're only going to share a small amount of their data, because for them, that's how they make their money. So they're going to charge you $3,000 or $5,000, maybe $7,000 to access that report, because that's how they make their money.
Right.
So you may be able to get snippets of it, the excerpts of their report that they allow the public to see, and put the pieces together if there's no other way for you to get that information.
Yeah, Profit Sense. I mean, I agree. I mean, I looked at Profit Sense for my company, and they want about $7,000 for the full suite of product, that they have. Whereas the SBDC, we have the scaled down version, costs about $3,000. You get it for free by going to SCORE or these other organizations. And then you get consultants, free consultants, by the way, who are willing to work with you to understand and crunch the data and get you the information you need. Strongly recommended. Otherwise, you'll be paying big bucks to get that data. But free at the public library, go online. It's not hard to get industry data. There's an organization called I think it's called the Risk Management Association, and the Risk Management Association, they accumulate that kind of data, but I think you have to pay them to access it. But it's out there. It just takes time and the wherewithal to go get it. Okay, I'm surprised that we are actually using up the whole 3 hours. So the next tab over is the break-even analysis. Remember earlier on, when we were entering the sales data, we figured out how many units do I have to sell in order to get to my desired goal.
Joseph, can you make that shot a little larger? It's hard to see. Thank you.
Okay. So, good. All right. How's that? That good?
That's a little better, yes, thanks.
Little. Okay. Okay, so break-even analysis is simply that. How much does it take to break even? You can figure out how to break even in terms of the number of units sold or in total dollars of sales, right? That's relevant because you may want to know what it takes. Like I said earlier, if you can get to in year one, if break-even dollar in sales after all is in and you've done your calculations, if you know that if you come May 31st, you've made $9 million in sales, and you still got 9 months, 6, 7 months left to go in the year, you're going to be in profit mode from there, right? So you want to get to break even as fast as you possibly can. That's just a key that's a metric that is useful for you to understand. The next one is an amortization schedule. We're not going to get into this. All this means is, I know it's small print, but all this means is that, you're paying down debt, because every time you make a loan payment, part of it is interest, part of it is principal. That's called an amortization. So this only tells you, how you do that. If you're interested in looking at it, we're not going to spend any time on that because that's too much in the weeds. And finally, we're towards the end here, folks. Financial ratios. Remember what I said earlier is, you know, yes, you want to know what your income statement is going to look like and all that, and maybe the balance sheet and the cash flow statement. But if you're running your business day to day, you're going to want to know, where are you strong, where are you weak? And I can tell you that when you go to a bank and ask for a loan, and they ask you for your financial statements, and they ask you for your tax returns. Because the tax returns also collaborate what's on the financial statement, by the way. And then there's a link between the two. But you give them that information, they're going to take that information, they're going to plug it into their tool, similar to what we're looking at here. And that tool is going to give out certain financial ratios. Now, we've got just a few here because there are many out there. There's something called a liquidity ratio.
Joseph, can you make that larger? It's hard to see.
I keep forgetting to do that to you. Thank you. Sorry.
Good, thank you.
So year 1, year 2, year 3, notice here we have industry standards. They're not listed, but there are industry standards. So you have liquidity ratio, safety ratio, profitability ratio, and the efficiency ratio. And each one of these lines is a different type of ratio. So we're not going to teach that to you right now because there are so many out there and you'll see these numbers, but this is what analysts do. They look at it. After all is said and done, they got the financial statements, income statements, balance sheet, whatever. They look at that, that's all well and good. Then they crank these numbers out and they want to know things like, let's talk about the current ratio. You'll see we have a note, an indication of a company's ability to meet short-term debt obligations. Well, banker's going to want to know that, right? Because you're asking to borrow money. They want to know, can you meet the debt payment? The higher the number, the better, right? So here we start with 2.8 for year 1, year 2 is 4.7, year 3 is a whopping 8.1, right? However, if the current ratio is like 1 or -1, you can't meet your short-term debt obligations. This is the stuff that bankers and analysts look at to determine the strength of the business. It's not just the numbers and the dollars. It's also the ratios. So the stronger the ratio, the stronger the business, the more likely you are to get investment money. Or if you, let's say you don't care, you're not going to go for debt. Let's say you're happy. Let's say you're debt free. You're happy, without debt. So maybe the liquidity ratios don't matter to you. Maybe you're totally liquid. You don't care. Maybe your thing is, I want to know how we can make this company more profitable. What is my profitability ratios? So you go to these ratios, and you see, sales growth starts at 0 because that's what we determine. But remember, I said year 2 is 10%, year 3 is 25%. So cost of goods sold, that's what feeds into the gross profit margin. It's 23%, 22 is constant. So the profit margin gross is going up. So all these ratios, they start to tell you a story about your business. Is my business strong? Is my business efficient? Look at days in receivables, and this calculates the average number of days it takes to collect a receivable. So 15. Well, what is the industry average? If the industry average is 10, then it's taking you longer to collect receivables. There's something wrong with your collection efforts, or something else is wrong. Maybe you have clients that are trouble, right? And that's showing up in how long it takes for you to get paid, right? You may have to reevaluate your clients. Accounts receivable turnover. It tells you the number of times accounts receivable turnover during the year. That's complicated. Days in inventory, so sales to assets, all these types of ratios, they tell you something. Here's one that's interesting: owner's compensation to sales. 1.6%. Like I said earlier, maybe the officers are not getting paid, taking enough compensation out. So the takeaway, you don't need to understand. I mean, you can get the video on the recording on this or whatever, but the takeaway for you is that you have your data that gets booked into and creates an income statement or set of financials. And those financials then get converted to ratios. And those ratios with the income, with the financial statements, tell a story that the professionals utilize to analyze a business. And my recommendation to you is, if you're thinking about going in for financing or going in for a loan, my recommendation to you is you do this exercise before you ask for a loan. Because if you go into that bank and you give them numbers that have weak ratios and weak analytics, they're likely to reject your application. Wouldn't it be better to deal with this stuff and figure out where your strong points are and where your weak points are before you go to a bank? And wherever your weak points are, you try to figure out a way to strengthen those weak points. And then strengthen the weak points, take corrective action, and then go to the bank. Now you're thinking, yeah, but that could take time and I need the money now. Yes, but by doing this exercise, you've identified weak areas. Yeah, do the application. When the bank says, nah, you can say, well, is it because, what was the ratios? And you can say, we fixed that problem. We know we were weak. We had a problem with ABC. We fixed it. But how do you know you have a problem, right? You know you have a problem by doing this exercise. If you know what they're looking for before you go to them, you've got a heads up, you got an advantage, and you can fix your problems. Number one, because it's good business. And number two, it's really professional when you talk to a banker or a loan institution and you understand the numbers, you understand the problems, we fix the problems, we're aware of it. And that's very comforting to somebody you're asking for money. And with that, the final tab is where you'll see, and I'll make it bigger. I finally remember at the very end. So this screen here tells you, looking at the ratios we talked about, right? Here's some ratios and percentages, whatever. Here's the interesting thing. Products like Profit Sense that Deborah mentioned earlier, and the other one, I forget the name, what's the name of the other one?
It was Ibis World.
Ibis World. So these types of products, they will not only give you the percentages and the ratios and that feedback. What I like about them is they also give you some analysis and some recommendations and some information. Like, for instance, owner's cash injection into the business, 0.9%. Well, artificial intelligence is telling us that owner's injection might be too low in relation to the amount of money needed. Cash requests as a percent of total required funding. Cash request exceeds 20%, which might be high. So now these products can give you recommendations and analysis, and maybe in relation to industry standard. Like, for instance, here it says interest rate seems reasonable. Well, that's good to know, right? How do you know whether you're high or low? Well, the data is out. We can figure that out by artificial intelligence and responses from software. Loan term seems within range. That's good to know. Here is commercial mortgage interest rate. Interest rate may be too low. Is there such a thing? Or the loan term seems within range. So you got all these, all this feedback, and this is just a small sampling of the feedback. Here, 76% of gross margin percentage seems reasonable. Good to know, right? If you have this data available to you, you can look at the weak points, the strong points, And then forget, and if you can make the strong points better, of course, but if you know that you have some weak points, well, what can we do to make them stronger? Well, it's comforting to know that something you have feedback telling you where you stand, and this is data within the financial statements, where you stand with your numbers and with your business, and then you can start to make decisions and understand. And this is what I said earlier, that this helps you become a CEO, helps you become a thinker of your business, taking a step back. And one of the biggest problems we business owners have is we wear so many hats, we don't have time to step back, and even a vacation is like half the time is on your cell phone trying to take care of stuff, right? So who has the time to sit back and think and project? But if you can swing it, it's money well spent, because this exercise is an investment in your business that will help you grow the business, become more profitable, shed problems, and strengthen your business, and make decisions and direct the ship to where you want it to go. So that, my friends, is the whole snippet of what it takes to do projected financial statements and the benefits thereof and the final product, which again, I would encourage you to try just get to the analytics part and let somebody else put the data together. Don't get into the weeds. You don't need that in your life. And with that, I'll take any more questions.
I don't see any more questions, Joseph. Oh, Ben has a question. Oh, what does Ben say? Hold on one second. Let's see. Ben says, wow, this is awesome. Camille says, thank you, very helpful.
Oh, thanks. You're welcome.
Okay,
Yeah.
so yes, this was fantastic. So thank you so much, Joseph. We have like 10 minutes left. Do you have enough time to get into business structure, or should we invite you back at a future date?
Well, it's your call. I mean, if you want, I could do a quick talk through some stuff that I find is very, a lot of business owners
Okay,
have.
the floor is yours. Go for it.
Yeah, so one of the things that I find myself answering a lot of the same questions over and over, and a lot of confusion is, how do I structure my business, right? So there are different types of structures. So the first, you got a sole proprietor. You have a sole proprietor LLC, let's call it that, right? A single member LLC is simply a sole proprietor with the LLC designation. You have a partnership, which is 2 or more business owners. And then there's a multi-member LLC, which is basically a partner LLC. It's an LLC with 2 or more members. You have a limited partnership. A lot of people don't use that anymore, very less known. You have joint ventures, like you may get 2 drug companies to get together to put together a product. That's a joint venture. And then you have a corporation. You have a C corporation and an S corporation. A C corporation, when you become a corporation, you become a C corporation by default. An S corporation, you have to ask to be an S corporation. So those are the different types of companies. A sole proprietor is very simple to set up. You don't even need an EIN. I recommend an EIN because you don't want your social security number being the identification number for the business. But you can just say, you wake up one morning and say, I'm a sole proprietor, and start selling widgets, and it's very easy. Set up a bank account and you start your endeavor. The problem with a sole proprietor is you don't have a liability protection. If you're going to be a sole proprietor, I'd like you to be a single member LLC, which means you're still a sole proprietor, but you have an LLC, which means that if you do things right and you get sued, the business gets sued, they can never take your personal assets. If you're operating as a sole proprietor without this LLC protection, if you sell something to somebody and somebody dies and you have a house and cars, kiss the house and cars goodbye. At least with an LLC, the worst that can happen is they take whatever's inside the company, but they won't touch your personal assets.
So LLC protection, highly recommended, but it's basically the same thing. It's a sole proprietor with liability protection, and states are the ones that issue the LLC designation. And it's a state issue. It's a legal issue. It's not an accounting issue. A partnership is similar to a sole proprietor in that you have two guys, two girls get together, they start a partnership. They don't register it, they just start. So the IRS wants to know that you're a partnership, so you're gonna have to get an EIN just for a partnership. But you can do that without having an LLC and the protection of the LLC. You can just have two partners and get started. It's the same amount of hassle to, instead of doing that, just do the same, but get the LLC designation. And this way, if the business gets sued, your personal assets are protected. And the multi-member LLC files its own tax return. And a partnership does too. Is Form 1065, which is due March 15 of every year. And if you miss that deadline without getting an extension, the penalty is $200 per month per partner until it's filed, or a maximum of 12 months. So that's a steep penalty. If you don't have your numbers ready, get an extension. I did 100 extensions yesterday. I got out of here like 11:30 last night. So there's that. Then liability protection simply is, in a nutshell, if the company does something, sells something, and somebody dies and there's a lawsuit, your personal assets are protected. And it's a legal issue. Talk to an attorney about that. Limited partnerships, like, we're not going to get into that because it's so rare nowadays for small businesses. Corporations are, like I said, you want to become incorporated. The only thing I would tell you, if you want to become incorporated, is you can do that, but you then need an attorney. You need an attorney for all this, but you need an attorney. You need to make a lot of decisions. Can you guys see that screen well? Is it too small?
No, it's sort of small.
So, so a corporation, if you want to become incorporated, you can do that, become a corporation, but then you're going to need, of course, you need an EIN. You need to have annual shareholders meetings. You need corporate resolutions. You need stock certificates, and you need to do this every single year. And the reason why you have to do this stuff is because if you don't this is called maintaining the corporation, right? Shareholders meetings, all that stuff, maintain the corporation. If you do not do these things, and the corporation gets sued, it is entirely possible that in the court, they'll look at the corporation and say, well, you didn't run it as a corporation. You didn't do any shareholders meetings. You didn't do everything that's required. You know what? Forget about it. You're no longer a corporation. We're just going to take that away. You're personally liable, for the lawsuit, right? So what I tell people is, instead of becoming a corporation, become an LLC, and you can tell the IRS, I want to be taxed as a corporation, because a corporation, a C corporation, pays taxes. An S corporation does not pay taxes. The income passes through to the shareholders. But you can accomplish the same thing that you do with a corporation. You can accomplish the same thing with an LLC without the burden of having shareholders meetings and all that stuff. So each type of organization has different requirements. And one of the things that I wanted to bring to your attention is, if you want the benefits of a corporation or a C or an S corporation, you can become an LLC. You can elect with the IRS to become taxed as a corporation and as a C corporation or as an S corporation. So basically, you get the simplicity of an LLC with the benefits of a corporation. So usually the people who do corporations are people who want to grow large. They want to go public. They want to get a lot of investors. But if you just want to have a small family-owned business or whatever, you don't need a corporation. You can just get an LLC. And with that, talk to an accountant, a CPA, or an attorney about the benefits and stuff like that. But that is what I recommend. Business entity considerations. Startup businesses should carefully consider how they want their businesses to be set up and taxed. We do that all the time. I recommend you talk to your local CPA and get some input on how to structure the business before you go do it yourself. You don't know what you don't know. We do. And if you make a mistake, you might be stuck in that mistake for 5 years, because you can only change the corporation status like once every 5 years. So if you're a startup, do the planning now before you pull the trigger. Now what else? Accounting considerations. We talked about accounting. We're not going to talk more about accounting. Balance sheet, profit and loss statement, expense classifications. As you saw, you have selling expenses, administrative expenses. It's just knowing where to put the numbers. Yeah, if you want me to come back, this could be a lot, but we can always get into more nitty gritty. We can get into tax planning and stuff like that, and things to do.
Well, I think now what the participants would like to know is, how do they reach you? Because we've had some comments, people are actually emailing me, and they're saying they want to reach out to you to talk to you about their business more, one-on-one. So how do they reach you? How do they make appointments with you?
Yeah, I mean, how would you like me to give it to you?
You can put it in the chat, or you can just say it and I can type it in the chat for everyone, or I can.
Where is the, yeah, so let me get, there it goes. I'll put it in the chat. How's that?
Okay.
To all panelists and attendees. So, and then, if you want, I could always come back, and because I enjoy giving out this information. I think it makes a difference in business owners' lives when keep money in their pockets.
Well, I think the way that you presented this material, it is very technical and it can be very mind-boggling for people, but I think the way that you presented it was very easy to follow. I'm not a numbers person, and I was able to follow it. So I think you really helped to, and then we had the visual with the spreadsheet. So you walked us through this imaginary company and how you how you came up with the assumptions and the numbers. And so I think it was very beneficial for me, and from the comments that I've received, it's been very beneficial for the attendees as well. So thank you so much for really breaking this down into bite-sized pieces and really explaining it in layman terms so that we could all understand how to go about this. So let me see.
Thank you for that. Appreciate that.
Okay, so Joseph's information is in the chat. He has his phone number there and his email address. So please reach out to him. This is his business. This is what he does. He is the expert. So if you need assistance, reach out to him. And I am sure, based on the presentation that he gave today, he will be able to walk you through it and help you to understand better, and then provide you the service that you need for your business as an accountant, should you choose to hire him to work with your business. So as you know, we are all business owners, so we're here to make money. So just keep that in mind. I'm sure Joseph doesn't mind sharing his information, but he is a business owner as well. So just keep that in mind as well.
Yeah, I like to say half the battle is making the money, the other half is keeping it from taxes.
Right. Okay, and then Tania says that she has limited bookkeeping and accounting experience and found this very enlightening. I now understand what I'm looking at. Great, and that was the point. That was the point, to help you understand what you're looking at, why you need to be looking at it, and then how to use the data to make decisions. So Joseph, we're gonna have you back, because I really am very taken with the way you presented this. You made it so easy to understand. And like I said, I'm not a numbers person. I've taken financial accounting classes for non-financial people, and I've walked away with a major headache. I've taken accounting in college and still didn't get it. So this has been years in the making. I wish I had met you decades ago. I might be in a better position right now, but all right, everyone. So thank you so much. It is 12:01. I want to be respectful of everyone's time. thank you again for participating in this webinar. Joseph, we thank you for your guidance and facilitating this webinar, and we look forward to working with you again. So please reach out to Mr. Reyes, and he will be able to assist you with your business. Thank you, everyone. Have a great day.
All right, guys, stay well. Good day.